Hi, my name is Bob Iaccino. After 12 years developing a system which last year generated a 73.3% win rate and beat the S&P 500 by 254%, I've decided to share my story. I urge you to keep watching because I believe 2021 will be a crucial year for all of us. Rewind about 20 some odd years. I woke up that morning with a terrible headache. The pain was absolutely unbearable. And while I was on the verge of one of the biggest years of my trading career, there was just no way to focus through that kind of pain. I remember how my wife whispering in my ear, "Do you want to go to the hospital?" felt like a sledgehammer to the side of my head. A few hours later, after vomiting from pain, my wife rushed me to the hospital. A long afternoon of painful tests later, and nothing. Nobody could tell me what was wrong. They pumped my body with painkillers, scheduled an MRI, and sent me home. Fast forward to Easter weekend. My wife and I would drive to my mother's house to spend the day with her and my father. I woke up that morning and I couldn't see out of my left eye. It wasn't dark, but more as if someone placed like a white sheet of paper over the left side of my face. I kept it to myself, thinking it would just clear up. I was wrong. I knew the situation was far too serious for me to continue hiding it from my wife. Once I told her, she forced me to pull over and drove me to the nearest hospital. Just like last time, test after test showed nothing. This time, though, they immediately sent me to get an MRI. And the following morning, my doctor said the scariest 5 words you'll ever hear. You have a brain tumor. It's very difficult to describe what you feel and what you go through when you hear those words. For me, the typical thoughts of family and friends and how much time I might have left flooded into my brain. But something else hit me as well. Work. My trading career had been moving along in big ways. From my early days on the CME, Chicago Mercantile Exchange trading floor, for working for Japan's 3rd largest brokerage house, to a new role at Smith Barney, who had just bought the brokerage house. My success to that point hinged on one thing, my brain. As you can probably imagine, it felt uniquely cruel that the thing I relied on the most was now literally in a position of killing me. I didn't know it at the time, but it was a blessing in disguise. I'm not going to bore you with the details now, but the important thing to know is the brain tumor devastated my pituitary gland. The pituitary gland is no larger than a pea, and it's often referred to as the master gland of the human body. One of its functions is to control what's known as the stress response. Harvard Medical School puts it this way: as the initial surge of epinephrine subsides, the hypothalamus activates the second component of the stress response system, known as the HPA axis. This network consists of the hypothalamus, the pituitary gland, and the adrenal glands. There's a very complicated neurobiological response your body goes through when confronted with fear or stress. In fact, this process literally alters how you behave. It's this process which makes some people freeze in the face of danger or jump into action. So what does that mean? Well, in a very real way, I have no physical sense of fear or stress. In other words, the biological changes which alter how you think and process information under stress no longer happen to me. Let's say you've been afraid of heights your entire life. Now imagine waking up one morning and being able to stand on the top of the Empire State Building without a care in the world. How would your behavior change from that point forward? What would you do knowing you wouldn't physically feel extreme stress or fear? Well, that's precisely what happened to me. Now, intellectually, I know if I'm in danger or not. But unlike most people, my body doesn't trigger the stress response when faced with stressful situations or emotions. What does this have to do with trading in the stock market? Well, if you're in the stock market, you fall into one of 2 groups. You either give in to your emotions and follow the crowd, or you ignore the crowd and gain from others' fears. Everyone likes to think they're rational and dispassionate when it comes to trading. You've likely heard the advice of not getting emotional when it comes to trading. Whether by coincidence or not, my trading and investing success skyrocketed after my ordeal. And due to my own natural curiosity, I needed to find out why. I came across an interesting study out of MIT, which found a clear link between emotions and trading performance. The more intense the emotions, the worse the performance. And there's more. According to a popular trading platform, 80% of traders lose money in just 1 year, and the median loss is 36.3%. Here's another troubling fact. A North American Securities Administration Association survey concluded 70% of traders will lose nearly all of their money. You've likely heard legendary investor Warren Buffett once say, "Be fearful when others are greedy, and greedy when others are fearful." That's great advice, but most people can't do that. And in fact, it's not even your fault. Most people simply can't control the stress response and the biological chain of events which occur. The fact is, this neurobiological response happens automatically, and it alters the way you think. In most cases, this is a good thing. It's your natural fight or flight response. But when it comes to trading, it's completely harmful. Which is why over the last 28 years, I've been developing a system which removes the emotion on your part. Not only have I seen with my own eyes the danger of being too emotional with the markets, I've also experienced how much more successful I've been since my tumor. I began fully running this system with real subscribers back in March of 2020, and here's a quick snapshot of the results. Plus 18.97 in March, plus 4.51 in April, plus 3.98% in May, plus 3.81% in June, minus 3.4% in July, but plus 10.86% in August, minus 2.72 in September, and then again, plus 4.30 in October. Add to that, plus 7.15% in November and plus 4.19% in December. That's a cumulative return of 62.79%, which is 254% higher than the SPY, which is the most actively traded ETF that tracks the S&P 500 index. Keep in mind, I'm not talking about theoretical backtesting like some people try to pass off as real results. These are the real published alerts and the results from the system. As you can see, we had 2 losing months, but the losses are small compared to the wins. That's how the system is designed to work. See, even though we have an over 70% win rate, the reality is all trading systems have some level of risk, and all systems generate losers. However, taking this emotionless approach, we've been able to keep the losses to a minimum. Even more important, I'll explain in just a minute how using this system will be even more important in the year 2021. This approach could transform your trading results and lead to life-changing results. And by results, I mean a greater than 70% win rate and beating the overall market by 2.5 times in 2020 alone. As I mentioned earlier, I started my career in 1992 as a phone clerk on the CME trading floor. I wasn't very good at it. I struggled in the early years, and I was a horrible trader when I first started. But then I started to gain confidence as I began to understand the markets better. Then in 1996, my brain tumor changed everything. It gave me, honestly, an unfair advantage because I was finally able to remove emotions from trading. For me, this was very much literal. Over the next decade, my career completely transformed. I went from the Chicago trading pits to some of the biggest banks and brokerage firms in the world. I worked at Smith Barney and at Germany's Commerzbank. I ran my own commodity pool at a Chicago-based trading firm. I was a principal and a member of the investment committee for a very successful hedge fund of funds. And the list goes on and on. I've also done over 2,000 interviews dealing with the markets, where you may have seen me on CNBC, Bloomberg, Fox Business, Yahoo Finance, TD Ameritrade, and so on. Through all of this, I discovered a very simple truth. Trading is hard, and anyone who tells you otherwise is being less than truthful. It can be an expensive roller coaster ride of emotions. When you're on a winning streak, you feel like you're on top of the world, but then you make a few bad decisions and it's all gone. Months of hard work and profits gone, sometimes in just one day. I'm sure you've been there. It turns your stomach. You feel dumb, like a failure. Maybe your position was too big. Maybe you didn't cut your losses. Maybe you just held on and hoped the market would turn around. The bottom line is your emotions got in the way. It happens to everyone. Trading can be nerve-wracking, and sometimes it can get even worse. Take 2001, for example. At the time, I was running a trading desk for Commerzbank Futures. Back then, it was the third largest German bank in the world. The day started off as usual. I was on the CME trading floor with other traders, Peter Ori on my left, Paula on my right, when suddenly the phones lit up like a Christmas tree. Call after call came in, rapid fire, just one right after the other. The pit erupted into an almost deafening roar. This was something I was used to. Anytime a piece of news would happen, hit the wires, or the Fed would make an announcement, you'd get what I could only describe as pure pandemonium. I did what I normally did. I checked our positions and our clients' positions to make sure we weren't overexposed to whatever was causing this roar, then waited for it to die down. This time, though, it didn't die down. This wasn't typical. I looked up at the giant jumbotron on the trading floor and immediately knew this would not be my typical day. A hijacked plane smashed into the World Trade Center. It was September 11th. Then 15 minutes later, another plane crashed. About 45 minutes later, an announcement blasts through the PA system on the trading floor. The United States is under attack. We're told to evacuate, but the desk I was running had a large number of trades still open. I asked anyone with kids to leave and go home to their families. For everyone else, I let them know it was up to them to stay with me as we closed out these trades. But no matter what, I'd be the last one to go. As hard to believe as this may be, I wasn't afraid. I wasn't freaking out. I was very calm. And for the first time, but not for the last time, I remember thinking, thank God I had that brain tumor. I knew the gravity of the situation, but like I said before, I don't exactly feel the fear or stress, which is why I continued to manage the trades. And the last thing I did was to close a trade that I had opened that morning, which I wasn't supposed to do. You see, the rules of that particular system said we were supposed to hold that trade for 2 business days. But this was an unprecedented event in history, and I knew that the best thing to do when you have no data to go on was to eliminate the risk. Guess what? Turns out that trade was a huge winner, and my clients made more than 10 times the money they were supposed to make on that trade. I knew the trading floor was going to be shut down for 4 days, and we had no idea what was going to happen or when it was going to reopen. Doomsday thoughts ran through everyone's mind. Will there be a full-fledged invasion? Are we safe? Will the markets crash? Nobody knew. I learned a few things that day. First, news stories and unexpected events shock and scare people. It doesn't even have to be as big as a terror attack. The fact is, most people go into fight or flight mode quickly and easily. Second, I learned anything can happen at any time, even the impossible. Before 9/11, the general public was completely oblivious to the possibility of a terror attack of this scope on our soil. What's worse is, no one can accurately predict an event like this. So what do you do if you can't predict these events? How can you safely navigate the market without big losses? Despite all the craziness in the world, in the news, and in politics, how can you consistently beat the market without great stress, without typical hesitation, without constantly watching the market and living tick by tick? Is it even possible? Academic studies going back decades prove time and time again, active traders who watch the market tick by tick have a hard time making money. In fact, the opposite is generally true. They lose money, and over time, they tend to lose all their money. The evidence also shows following the crowd is a bad idea. A recent study makes the point obvious. It examined Robinhood traders from May 2018 until August 2020. It looked at events where traders crowded into specific stocks. The most recent example of this is the craziness around GameStop, ticker GME. What they found is prices usually spike, then reverse. Usually the reversals are extremely painful, and in the case of the Robinhood study, the reversals actually became negative returns. We don't chase things like GME because, number one, I don't really feel the great FOMO that other people do, thanks to my tumor. I know the value of sticking to the process, but also because we were around for pets.com in the crash of 1999-2000, we remember what the aftermath of these frenzies look like. Another study tracked 1,600 Brazilian day traders for a year and found that 97% of them lost money. 97%. In fact, Only 1% of them earn more than the Brazilian minimum wage. There's more. A study in Taiwan used complete transaction data for the entire Taiwan stock market over a 15-year period. Their conclusion? Less than 1% of the day trading population is able to reliably make money trading. And don't think for a second that applies to the amateurs only. Academic studies overwhelmingly prove professional money managers underperform their benchmarks over a multi-year period. In fact, a staggering 85% of professionals fail to outperform. I could keep going, but you get the idea. Making money in the markets is hard, but it's not impossible. I've spent decades in this business, and I've had only 3 down years. Now, how did someone like me, the son of Italian immigrants from the west side of Chicago, succeed for so long while the vast majority of traders failed? For me, the answer is obvious. You need a system, a process. A trading system that can consistently beat the market, take emotions out of trading, and can survive the ups and downs of the news cycle and irrelevant events. I look for this type of system everywhere, but they're not just sitting on shelves at Target. What I was looking for wasn't available to regular people like you and me. Sure, Wall Street and big hedge funds have these tools, but not us. While I was at Smith Barney or Nico Securities and Commerzbank Futures, I had access to the best tools in the world, the best software money could buy, the types of systems you couldn't possibly imagine, but they were no longer available to me when I went off on my own. Have you ever felt like you just can't win? Well, you're 100% right. You can't win. And someone else who's much richer, much more connected, and much more powerful is winning day after day while the rest of us struggle and lose money. And the fact is, the playing field simply isn't level, not by a long shot. But that didn't stop me. It actually motivated me. I became obsessed, so I started building my system, and I did pretty well. But I couldn't do it all on my own. I needed help, and the help I needed was lurking inside the very hedge funds that I was looking to beat. After 8 years of relentless work on this emotionless system, I met a very special human being. Let's just call him Oz, the man behind the curtain. He went to Northwestern University, received a master's in electrical engineering, he's a math whiz, and he's an insomniac. During one of those sleepless nights, he created and patented a technology that helps to power red light traffic cameras. I hope that doesn't make you hate him. Later, I would learn he was the man who hedge funds actually hired to break their systems, literally. We met after Oz bought one of my courses and showed up at my live event at the University of Illinois. With around 100 people in the room from all over the country, he comes up to me just before lunch and says, "Hey, my name is Oz. I bought your course and it's great, but I can make it better. Would you like to know how?" Now, a lot of people in my position would have likely ignored him. But not me, though. After the last session, I met up with him again to see how he could improve what I had developed. And sure enough, he actually did exactly that. The changes he made are technical, so I won't bore you. But I knew I had to partner up with him. I knew we'd develop the type of system I was after. What I didn't know back then was that was the start of what I now call the 10-stock system. My brain tumor, my 9/11 experience, meeting Oz. These events were random and unrelated, but all of them were needed to create the type of system I knew people like you and I needed. And remember, the criterion is simple. The system must consistently beat the market, take emotions out of trading, and survive the ups and downs of the news cycle and irrelevant events. Let's take that first point. The system must consistently beat the market. Take a look at the 2020 track record. I started sending alerts in March 2020, and we did as follows. Remember earlier when I told you we had 2 months last year showing losses? Well, the system is designed to be emotionless, so these losses didn't hurt us, not one bit. In fact, as you can see from the chart above, we beat the S&P by an astounding 254%. But what does that mean in real life with real money? Let's say you have a $25,000 portfolio. How does the 10-stock system compare with some of the other things you could have done in 2020? The first option is trading it on your own with no help. Could you have gotten lucky? Definitely. But study after study shows the more likely scenario is you would have taken on massive losses. In most cases, you would have lost it all trying to trade. And remember, that's not me saying it. It's MIT, popular platforms like Robinhood, even the North American Securities Administration Association saying it. In fact, according to the NASAA, there's a 70% chance you would have lost nearly all of your money. So please, even if you decide not to use my proprietary 10-stock system, do not go it alone. The risk is far too great. Now let's say you decided to put it in an S&P index fund like the SPY. You would have made $4,425 or 17.7%. And that's not bad. But had you used my 10-stock system, you would have made $15,698 or 62.8%. That's 254% more than the S&P, a 2.5 times return versus the S&P. Remember, it's the same $25,000 portfolio, but the difference in the gains is significant. And get this, you actually take on less risk using the 10-stock system than putting it into an index fund. Take January of 2021, for example. The 10-stock system returned 5.96%, while the S&P, after making new all-time highs, turned around and fell to finish the month down 1.5%. This is because we took profits all month long and had very little exposure to the downturn when it came. And they always come. And then we have the last option, which is do nothing. To me, this is probably the worst category. It gives you the illusion you're playing it safe, but you're not. The problem with the do nothing crowd is they think they're protected, but they are not. Why? Because their purchasing power is declining. In fact, it's getting obliterated. Take a look at the U.S. money supply chart. The amount of dollars in checking accounts in the banking system exploded in 2020. It increased at the fastest rate in history. Now zoom in on November 2020. Do you see the jump of more than 1 trillion? That means inflation is around the corner. Frankly, it's already here and you just don't know it yet. See, the government tells you inflation is only about 1 to 2%. That's because the government's metrics for calculating real-world inflation are at best outdated, at worst a complete fraud. I can't believe I'm about to say this because I love this country. My father came here as a legal immigrant with a green card and became a citizen, worked hard, joined the middle class. I still believe it's the greatest country on earth and I consider myself a patriot. But the way our government portrays the level of inflation to the people reminds me of how deceitful China is with its people. So if you're in the do nothing crowd, you're in a really bad spot. You think you're saving your money, but you're not. You're letting it sit in a bank account and it's wasting away at an alarming rate. You could no longer stand on the sidelines. You have to act now because this situation is only going to get worse. Let me tell you what the 10-stock system is. The core portfolio never has more than 10 stocks. And with every alert, you get the entry points, price targets, and stop losses, and any adjustments we're recommending on any open trades. In other words, each trade has a defined risk. Why? Because this hits on the second point of the perfect system. The system must take emotions out of trading. Let me show you some recent examples. Take a look at Intel. In this example, we took our profits before the drop. We made 11%, while others might have lost over 20% if they held through the price drop. And we know by studying trader psychology, that's exactly what most people do. This is one of the major benefits of the 10-stock system. By following it, you take profits constantly and consistently. While other people could be down 50% in a crash, we could be up 30% because we limited the risk ahead of time and get out while everyone else keeps piling on losses. Another strategy we use to manage our losses is timing based on price action and stop loss adjustment. We get in and out of the trades within weeks, and we raise our stop losses when needed to protect capital. In a moment, you'll see why this is so powerful. That way, when we hit our profit targets, we get out and move on to the next trade. We don't look back and wonder if we could have made more because it's irrelevant and counterproductive. Remember, the key is to remove emotion, not give into it. The reverse is also true. If the stop loss gets hit, we don't watch to see if price recovers. We simply move on. Losses are part of the game. You should always expect them because it simply doesn't matter. As you saw from the chart earlier, Our system gave us 2 losing months, and yet we beat the S&P by 254%. If you want to play this game, you will win and you will lose. And my job is for you to win more often than you lose. My system is designed to win roughly 70% of the time. The key is precise methodology combined with appropriate risk management, and based on our performance in 2020, I know this approach works extremely well. Something else to consider is that we generally look at over 4,000 stocks, and then we narrow it down through our proprietary process to about 100 to 200. And ultimately, we pick the best ones. This allows us to focus on the most profitable trades the market has to offer without wasting time with the losers. And since our hold times tend to be short, we're able to profit over and over again in a short period of time. Take a look at another trade we did in INTC, Intel, as an example. On March 18th, we got in at $45.50. We were out at $53.14 on March 24th, less than a week later. Intel kept going higher, but we do not care because we took our cash and allocated it to something else that was moving. Earlier, I talked about the timing strategy we use with the 10 stock system. Let me show you how powerful this is. Most people use a buy and hold strategy as a way of removing emotion from the equation. In theory, this makes sense, but in practice, it can actually be detrimental. Let's use these Intel trades as an example. As you saw, we traded Intel multiple times last year. But let's say that instead of trading using the 10 stock system's timing and stop loss strategies, you bought on January 1st and sold on December 31st. You'd be sitting on a 17.3% loss. Compare that to what the 10 stock system did with the Intel stock. Remember, this is the same company, Intel, as well as the same period of time. However, instead of buying and holding, we use the 10 stock system, and what you actually achieve is this. By simply following the system, you could have made a gain of 11.3%. But here's the kicker. Imagine we did this with multiple names over a full 12 months and annualize that 11.3% gain, and it becomes a 68% gain. In other words, we took what would have been a 17.3% loss and turned it into an annualized 68% gain. Can you see the power of combining this system of emotionless trading with timing and strategic stop losses? Let's look at another example, this time in Prudential. Take a look. We were in at $42.50 on March 18th and out at $54 on March 25th. Again, in a week for a quick 27.1% gain. Think about what that means. The only time your money can grow is when it's in the market. But the only time your hard-earned money is at risk is also when it's in the market. If you can pull a 27.1% gain out of the market in a week, that's an annualized return of 1,411%. But it gets even better. Had you gone with a buy and hold strategy, like in the Intel example, you would have had a loss of 17%, as shown here in this chart. Compare that to the 10 stock system, where we traded in and out of Prudential twice last year, with an average hold time of 75 days, and you get a whopping 142% annualized return. Simply taking profits and limiting losses, we took what would have been a 17% loss and turned it into a 142% annualized return. Of course, not every trade will be held for such a short period of time. Sometimes we'll see a trade where it makes sense to stay in a bit longer, more like a month or even more. Have a look at AMD, Advanced Micro Devices. We entered at $85 on November 20th and exited less than a month later on December 15th at $96.85 for a quick 13.9% gain. If you can pull a 13.9% gain out of the market in less than a month, that's an annualized return of 203%. Are you starting to see why the 10 stock system is able to beat the S&P and hand you hedge fund-like gains without having to constantly watch the markets? In the case of AMD, had you gone with a buy and hold approach, you would have done quite well. The total gain would have been an annualized return of 95%. We can all agree that's a great return, but using the 10 stock system, you would have more than doubled that gain. And what's even more impressive is all of this is done automatically for you without you having to think about it. Now take a look at Cisco. We got in on April 6th at $41.50 and got out a month later on May 5th at $40.95. As you can see, this was a loss of 1.3%. The momentum faltered and we continued to adjust our stop loss until we got stopped out for a small loss. And again, that's the beauty of the 10 stock system. We protect our downside. If we're up on a trade, we adjust our stop loss. We don't sit and watch our profits disappear. But then take a look at the very next trade, ARNA, Arena Pharmaceuticals. We entered at $51.25 on May 5th and exited on May 21st at $58, which handed us a 13.2% gain. On this trade, let's say you would have gone the buy and hold approach. Again, if you bought on January 1st and sold on December 31st, you would have achieved an impressive gain of 67.3%. Not bad at all. However, using the 10 stock system's timing and stop loss approach, we generated a 13.2% gain in less than 3 weeks. Annualized, that's a 300% gain. Another example we have from the system is EYE, National Vision Holdings. We entered at $31.50 on July 24th and exited on August 7th at $36.50 for a 15.9% gain. Had you bought EYE on January 1st and sold it on December 31st, you would have had a nice gain of 38.2%. Again, that's not bad at all. Following the 10 stock system though, we achieved a 15.9% gain in 2 weeks. That's an annualized 241% return. These are all real stocks traded with real money by our small group of members. And these are all real results. And since the goal is to be consistent over time and not take on more risk than necessary, the gains tend to be smaller. This is something I really need to stress. If these consistent winners week after week, month after month, and year after year bore you, then this is not for you. I need to state clearly, I'm not going to hand you the next GameStop. I have no interest in that type of trading. It's short-lived, irrational, nonsensical speculation, and that simply isn't what I do. Sure, it's fun when it's all going well, but eventually that crazy game of musical chairs come to an end. The music stops, as it always does, and the reversals are some of the most painful things I've seen. I've seen this movie before, and it's a horror story for most. Personally, I do think a small, very small portion of your capital should be in speculative trades, but that's not what most people do. What my 10 stock system does is simple. It wins consistently and with well-managed downside risk. The one drawback, if you can even call it that, is the individual stock gains are smaller. However, they add up to very big wins over time, as shown by the fact that the 10 stock system outperformed the S&P 500 by 254% last year. You may not know this, but the US stock market ended 2020 on all-time highs. Despite the pandemic, despite the shaky start to the year, it broke the prior all-time high record. Remember that study I mentioned earlier? Over 85% of professional money managers rarely outperform their benchmarks. What that means is the pros didn't beat the market. At the very best, barely kept up with it. The 10 stock system outperformed the market by a huge margin of 254%. Like I said before, if consistent wins just isn't for you, I hope you get some value out of what I've shared with you here, but we're not a good fit. However, if you understand massive home runs based on irrational speculation is extremely dangerous to your financial health and well-being, if you can see the value of consistently winning on your trades all year long, then continue to watch. Inside the 10 stock system, you'll get 2 to 8 trade alerts per month. The reason for the high level of activity is what I mentioned before. The wins are smaller, but we're increasing the timing of trades for bigger gains, which is why you get those 2 to 8 alerts per month. If you recall, my brain tumor destroyed my pituitary gland, and because of it, I have no physical reaction to stress or fear. I knew from that experience I needed to develop a system that mimics those same feelings for you. Now, I can't do anything, obviously, about your body's natural response to stress, and I certainly would never wish a brain tumor on anyone. But I came up with an ingenious way to experience little to no stress when following the trade alerts that I send you. How's that even possible? All the alerts are sent out at night. You don't have to watch the markets tick by tick wondering if you've made the right decision, and you won't be distracted by intraday craziness. Right before bedtime, which incidentally is the time when the least amount of stress hormones are in your body, you'll review the alert I've sent you, punch in a few numbers, enter your trade, and then when you sleep, with a peace of mind knowing your entire trade, position size, risk exposure, target, profit, etc., is already set. The only thing you have to do before the market opens is make sure you're not getting in below the stop price that we sent you in the alert. That's it. If there's anyone who knows the huge advantage you get by removing stress and emotions from trading, it's me. It's this edge that's given me a winning track record for at least 8 of the last 10 years. That's why the financial news shows always call me for interviews and feedback on the markets. Even as recently as August 21st, 2020, right in the middle of a pandemic, who did Yahoo News call? I truly believe sending you the alerts this way is how you win over and over again, by setting up the trade, the entire trade, before you go to sleep, and only checking it once in the morning, which allows you to go about your day without thinking or worrying about what the stock market is doing. Remember, the way I have you structure the trade, you'll know exactly when to get in and when to get out. Profits will be taken automatically. No need to stare at your screen all day long and run the chance of being emotional and having that get in the way. The downside risk is covered. You'll know ahead of time what your risk is. The upside profit potential is also covered. You won't have to wonder when to sell and take profits. Again, all of this is done automatically the night before when you follow the alert I'll send you. So in the evening, around 7 p.m. Eastern Time, you'll get an email which looks like this. Quick and easy. I'll tell you exactly what you need to do, and you'll have plenty of time to act. From the comfort of your own home, and in fact, so simple, you can even do it all on your phone. No need to even fire up your computer. Just a few clicks to enter the number of shares and your entry price, your profit target, and then let the market work for you. Remember, our profit targets are automatic. So when the profit target gets triggered, money is automatically deposited into your account. You don't do a thing. Imagine waking up with $5,000 in profits or even $10,000 and realizing you didn't have to be glued to your computer screen. You didn't have to experience the roller coaster madness of the markets. You did this without letting your stress and emotion get in the way. Another thing to keep in mind is that you'll always hear from me. Even if there's no changes to the portfolio on a given day, I'll still email you and let you know nothing's changing. This is white glove service, and I'll hold your hand every step of the way. And if you have any questions, if something doesn't make sense, ask me. I'll host a Q&A session to answer your questions about the service. Also, once a month, I'll give you my thoughts on the market and the economy. It's a quick read that will keep you informed. I also cover topics you might not read about in the Wall Street Journal or hear about in the mainstream financial media. I'm not going to sugarcoat anything. I'll tell you the truth. On top of that, you'll receive a portfolio update video from me every 2 weeks. I'm not the prettiest face on the planet, but every 2 weeks, I'll show up in your email looking like this. The most recent topics in my video have been the GameStop frenzy, as well as stimulus and that's effects on the markets. And finally, once per quarter, I'll review our performance. I'll look at our winners and our losers and summarize how we did compared to the S&P. As you might imagine, this type of service isn't cheap. Price is fair, it's certainly not cheap. The value of a lifetime subscription is about $10,000. The cost for a 1-year membership is $3,000. Like I said, it's not cheap, but it's fair. As I mentioned earlier, if you used a $25,000 portfolio and followed our alerts for 2020, the 10 stock system could have made you $15,698. So really, you shouldn't overthink this. Here's why. The moment you become a member of the 10 stock system, you get access to a suite of life-changing, money-making resources and benefits. And that's no exaggeration, as we've seen here today from members like our current member, Alan. Hi, Bob. Closed my 50th trade today since being a member since March 23rd, 2020. Closed realized profits, $27,911.20. Average $3,488.90 per month. Appreciate all your efforts and mentorship. Alan. The 10 stock system members receive access to my entire portfolio of alerts with detailed buy up to prices, entry and exit prices. In the past, subscribers who followed these alerts have seen gains as high as 27.1%, 23.3%, 19.4%. That's enough to pay for the service. Remember, one of my biggest benefits of my 10 stock system of alerts is you get to take gains over and over. It allows you to take thousands of dollars and large percentage gains off the table and not worry about whether the value of your portfolio fluctuates. And don't forget the video updates I send out every 2 weeks. I never hide from you. I'm just not wired that way. I'll give you the good, the bad, and the ugly on the markets. If the system is signaling for us to back off, that's exactly what we'll do, and I'll tell you about it. Now, as the newest member of the 10 stock system, you'll be lined up to profit immediately. The first thing you'll get your hands on is my position size calculator training video, where we dive deep into one of the most important areas of trading. The topic can be quite boring, but if you've ever asked yourself how much or how little of a particular stock to buy, or if you're wondering what to do with the 2 to 8 alerts that you get from the 10 stock system, this is a video you'll want to watch. Truth is, at $3,000 a year, the 10 stock system is a steal. And while I don't know how long I'll keep the membership open, I can tell you I'm already planning the next price increase because frankly, $3,000 is simply too good. But today, you won't pay anywhere near that. And that's for 2 very important reasons. First, because you watched this far, I know you're serious about finally being one of those people who knows exactly what to do amid all the Wall Street craziness that scares the hell out of everyone else without the dangerous ups and downs most traders go through. For this reason, I want to make it a complete no-brainer for you to join and take advantage of all the emotionless trading. And second, because this is the first time I've officially opened up the 10 stock system to a large group of new subscribers. Aside from the small circle of subscribers who have been profiting handsomely, this is the first time I've opened up access. For those 2 reasons, I'm going to offer you an incredible deal. I'm going to slash half off the yearly new membership fee. Instead of $3,000 for a very short time, you'll get a full year for half off. That's just $1,500. So today, you get access to hedge fund quality research, which allows you to profit without letting stress and emotions derail you. In other words, today only, and for a very short period of time, you'll get recommendations, guidance, and research into this market for around $28 per week. You see why I told you earlier not to overthink this, not to procrastinate? All you have to do is skip 1 night out at a restaurant per month, and that's enough to get you in front of these nightly alerts that can lead to very nice profits. Of course, not every trade is a winner, but with a 70% win rate, you'll have what I call profit windows more often than not. And those profit windows add up to very big gains, life-changing gains where you potentially never have to worry about money again. You can add those restaurant visits back in and more. So when you become the newest member of the 10 stock system right now, you'll get to join for just $1,500 per year, a 50% discount. You get it for half off the regular price, which comes to a measly $28 a week. You should see an order button below this screen now. You'll be taken to a secure membership enrollment form where you can review the details of your offer and make sure it's the right offer for you. You get all the membership benefits discussed here, instant access to the position calculator training video, the core portfolio, nightly alerts with full instructions, video updates every 2 weeks, and detailed portfolio performance tracking. You'll get all of this for just $1,500, which is just $28 a week. Plus another bonus. If you sign up today, I will send you an additional set of trades. I call them high beta trades. These are often faster moving and can include currency and commodity ETFs that don't make it to our initial screen, but still not only have the opportunity to provide you with extra profit, but can move faster and often farther than our core trades. They are riskier, but because we control risk and still use responsible position sizing, they can be a powerful addition to any portfolio. Last year, our high beta trades had a slightly lower winning percentage, but a higher reward to risk and shorter hold times than our core portfolio did, resulting in higher annualized returns. High beta trades made a full 24% more profit on average per trade than the core trades did. These can really move. Remember, if you want a full breakdown, you can click on the button now. This is a very time-sensitive offer being made to you. And I can tell you, you may not see the 10-stock system again, ever. Don't put this off. Don't procrastinate. At just $28 a week for a short time only, this is truly a no-brainer. Thank you.
And thanks for everybody being here. So what we're going to talk about today are two really amazing strategies that I like to use for any kind of market condition, but really when you get into extreme kind of market and conditions, you know, where there's a lot of uncertainty in those kind of markets, I like to really reduce the risk but still have the potential for the big return. And so these are two strategies that are really great for that. And that's the butterfly and the long condor. So again, thanks for having me here, and let's get started. So the following presentation here today is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice. It should not be construed as a recommendation. Now, to me, the secret to trading profits come down to three big things: direction, timing, and then managing your risk. And I like to do that through using different option strategies. And it also gives you some really great opportunities for, you know, better risk management, because there's so many different things we can do with options and different adjustments we can make. Now, you know, when you're trading options, they have so many more advantages than, you know, outright trading stocks. But as probably everybody here knows, they can be a bit more complicated. But once you understand the benefits and the advantages of options and option spreads, you're never going to really look back. So when used correctly, what option spreads provide are they're going to give you more defined trading risk, going to lower your capital at risk, provide greater returns based on the leverage, and they're an unmatched hedging advantage for your trade, you know, your trading, hedging, and you know, reducing and managing risk. Now, I've been trading options now for over 30 years, and I've found that the most valuable go-to option strategies that can literally help any trader more than any other trading strategy, and especially during extreme market uncertainty, is going to be looking to use the butterfly and the long condor. So they're kind of my trading secret weapon. Now, the huge advantage of these strategies is their unique option framework that's designed to take advantage of time decay, or theta, and then volatility, which are the two main option pricing components. So this really helps to stack the trading odds in your favor, and they can be used in any type of market environment, which makes them a great favorite trading strategy for more uncertain type market conditions. So if you just know when and how to use them, they're going to be a great thing to put in your toolbox. Now, because they're structured to require only a small amount of your hard-earned capital, your trading returns can be very explosive. It's kind of like what I call lightning in a bottle. And the butterfly and long condors they're very dynamic, so they can be traded for a variety of different reasons with, you know, different goals in mind. So in other words, once you learn how to use and trade the butterfly and condor, you're going to be covered for both your offense and defense, so your goals and protection. Now, the butterfly and long condor, they can also be used for a way to hedge, okay? So when you mess the trade up, and that's going to happen, these can become a really fast, low-cost way to cover your you-know-what pronto when a position starts to move against you. And I've found no other hedging strategy that even comes close to incorporating this into your trading plan. So by constructing either a butterfly or a long condor around a strike that is under pressure from another core trade setup, such as maybe you did a credit spread and it's starting to go against you with this, you know, price starting to go into your short strike, or you have a debit spread that's going against you. So these can become the best way to hedge those types of position by incorporating or putting a butterfly onto that potential original spread. So what it does, it can immediately neutralize your risk, but it's also going to lower the risk. So that's what makes it such a great way to hedge. And from one of my members, she said, I wish I'd known how to do this hedging before I lost so much money doing credit spreads. So if you do credit spreads, that is so true. You can have a lot of different, you know, great winners, but then you have that one loser because the price goes right through your short strike, and you're, you know, it can pretty much wipe out a lot of the prior winners based on that one bad trade. So this is a way to hedge that and reduce that kind of risk. Now, what you do is when you do this kind of hedge, what it provides you, it keeps the original position open by either putting a butterfly or a Condor hedge on that original position. So what this does, this strategy takes advantage of the time decay component or element of the spread. And so, while you're waiting maybe for that trade to stabilize and come back to the direction you were originally looking for, you're actually getting paid while you're waiting because of the time decay component. And, many times that's all you really need, just that little bit more time for the original position to stabilize and then move back in your favor. So at that point, then you could remove your hedge, stick with the original trade and ride it for what it's worth, or you could even leave the hedge position as it is with the butterfly or Condor and actually make out sometimes even better. Now, the way that these things work, they're fairly simplistic. They're based on vertical spreads. So when we look at this example here, this would be like a vertical call debit spread. So you're long a call and you're short a call. So you've got a total here of $300 of risk. That's your debit paid. So, that's your risk. And if it, closes above your short strike of the spread, you make your max profit. But what I try to always teach my members and clients is let's try not to lose our whole at risk on anything. So we could easily convert this to a butterfly and reduce our risk quickly by doing that. So what we would do is just add a vertical spread, credit spread to it, converting it to a butterfly. All right, so we could sell the short strike of the debit spread, and in this example, bring in $200 credit. So what we've done now is we've reduced that risk down from the original cost of $300. We've reduced our risk to $100, and this is what we call a balanced butterfly. So we went from that long call debit spread to a butterfly. Now with this, then you've got the opportunity, or you've got the option to, you could close out one side of it, or if you think it's going to, maybe go out between your within your profit zone here, you just leave it alone, and you could have even a bigger return on that lowered risk. So this is a really great strategy for hedging and a great one for legging into or legging out of. So that's the long call butterfly, and there are a lot of different variations which we'll talk about here a little bit later. So that's one really great strategy. Now the other one is the long Condor. And the thing I love about the long Condor, it's very similar to the butterfly, but it widens out our profit zone. So it gives you a bigger kind of sweet spot for the trade to work out. So here it could be, you're long that call, and you do this with puts or calls. So you're long the call debit spread, and then you can push out widen out that profit zone to give yourself a bigger area of, profit zone or sweet spot for the trade, versus the butterfly is a little bit tighter, kind of really thread the needle. Now the butterfly will bring in more premium, so it will really knock the risk down. But the long Condor won't bring in as much premium, but I like it because we can widen that zone out and have a really good area there for profit. So we'll look at a bunch of examples here in a few minutes. So they're very close, very similar. So that's why I kind of put them into the kind of call the butterfly family. Now the core concept that makes these two strategies work, the butterfly and long Condor, really comes down to the pricing elements of these spreads. So the most important option factor for profit generation when using the butterfly long Condor comes down to really understanding option pricing, how option pricing works, and the concept of time decay or theta. So again, time decay or theta is one of the bigger option components of price, and it has a big impact on the price of your option. And that's what we take advantage of with these two types of trades. So let's take a look at the kind of the core concept that makes this work. Now, when we look at theta, what theta does, it's telling us how much an option price will go down over time. So it's the rate of time decay of your stock option. And time decay occurs because the extrinsic value, or that time value, goes down every day until it gets to expiration, and which at that point in time, it's at zero. So it's a decaying kind of component of your option trade or option spread. And that's what we're taking advantage of. We're taking advantage of that theta decay, and then also volatility, which will also go to zero at expiration. So let's take a look at the kind of an example here of how that pricing works. It can really keep your risk super low. So in this example, we've got XYZ, and it's trading here at $45. and we're looking for a move down. In this example, just a small move down to 43. So we can directionally use the butterfly to target different target prices. So in this example, 43. So when I'm doing a butterfly and I want to target an up move, I could use calls, or a down move, I use puts. And the body of my butterfly, I'll usually put at my target price. So right here, so 43. So in this example, I'd be buying, excuse me, a June 44 put. It's going to cost $2.38. That would be $238, for one option contract. And then I'd sell the 43 put below it, bring it $1.67. And then I'm going to sell another 43 put and then buy the 42 below it to cap that potential risk. So what I've done here is created a butterfly. So then if we go through the math, you can see how you can really get your risk really defined. So if you look here, you're paying $2.38. We've just created this butterfly, narrow wing butterfly. So $2.38 plus $1.06, your debit cost here, less your credit received, $1.67 two times 100 to make it into an option spread contract. So you can see here we put our risk, or defined our risk, down to $10 per spread. So if you did one option butterfly in this example, your maximum potential at risk for losing would be $10. Now your profit is, just look at your spread difference, 44 less 43, or 43, 42. You can see it's $1 wide between these strikes. So you look at that, less the cost of the trade, 10 cents times 100, and that gives you your potential theoretical profit. So in this example, you can see that your potential profit is 90 cents or $90 per spread. And if you look at that on the risk of that one spread, if you did one spread, or whatever, your risk to reward is 900%. You're risking $1 to make 9. So these are a really great strategy for directional or neutral kind of trades, where you can keep that risk defined but have potential for big payoffs or return on your risk. Get my slide to change here. Now the next thing comes to what butterfly or condor strategy to use, and that's going to really be based on the market environment. What I look at are the kind of the cycle of the market environment, that uncertainty of the market, and then your trading goals as far as the risk rewards you're looking for in your trading capital account size. But the great thing with the butterfly condor, you can use it on any trading account size. So you could have an account of, trading account of $3,000 or whatever, or $1 million, and these are strategies that you can use. They're very easy and liquid, and any size portfolio can incorporate this. So in my opinion, the goal for every trader out there really should be to look to trades that are based on what's going to give you the most consistent positive returns over time with low defined risk. And I always look at risk first and then look at my reward. So in trading, I think of it as like hitting singles and doubles just to stay consistent, and then you're going to hit, over time, the big home run. But if you stay consistent with these types of strategies, you can stay, into the game a lot longer. Now, the best way then to achieve this is to know what those option strategies are available to you, understand how they work, and then select the one that's going to be best suited, again, for your market environment you're trading and your specific trading goals. Now, excuse me, when I look at the butterflies, I kind of, again, refer to the butterfly family. So there are a lot of different variations of the butterfly. You've got the long call or put butterfly. You've got a broken wing butterfly, or sometimes called the skip strike butterfly. We can use calls or puts. We've got what I call the ninja butterfly, which is an unbalanced or ratio butterfly, the iron butterfly, and then there's a category for hedging. So these are fantastic. Like I said earlier, they're the best way to defend a trade by either using an adjustment to a butterfly or a condor. And then we've got the long condor. So we're going to look at a bunch of different examples here so you can kind of get a better visual idea of how they work. So let's take a look. Now, the first thing, we'll look at a couple different butterfly setups. Now, when we look at the butterfly, the other thing is, when you're looking at a butterfly, you can adjust your risk and profit based on the wingspan. So if you were, out there trying to catch a butterfly or a bird or something, if you have a really wide net, it's going to be a lot easier to catch it, right? Versus a small, net. Now with the butterfly, we can then adjust our profit zone by what we call the wingspan. Okay, so we can make it a really wide butterfly, have a huge big profit zone, or if we really want to tighten up our risk, we can make it a narrow butterfly and tighten it up and have super small amount of risk, but a potential for a huge return on that lowered risk. All right, so that just depends on what you're trading, the cycle, etc. So we'll look at some examples to show you the benefits here. So let me get that next slide going for you. Now let's take a look here. The first one will be a directional long butterfly on SPY. So these are great to use on ETFs, SPY, QQQ, the Russell, etc. And they're also good for index options like the SPX or Index, things like that, and great for stocks. You can do these with futures, pretty much anything. So the first one is a narrow wing butterfly on SPY. So it's going to be a spread width of $100 on the wingspan. So this is an example here. I like to use Fibonacci for my targets. So here, this was on SPY. You can see we had a swing high here to low, and I've got a target coming in here. I was looking at right here, the 618 retracement coming in right about 274, 273, 274. And I also look at option activity. There's a lot of option activity here. So it gave a really good profit target or price target to trade to. And then we can set up our trade based on that target. So with this example, we're targeting 273, so kept it really narrow, bought the 272 call, sold the 273, and then sold the 273 again, bought the 274. So you can see the wingspan and the strikes price, strikes $1 between the strikes, right? So dollar wide spread. So the maximum risk here, if you take that dollar wide spread, which would be $100 less the cost of the trade. So if you did one butterfly spread here, 10 cents or $10, the potential return is the difference of $90 per spread, which is if you max it out by hitting exactly 273 at expiration, you can make $90. Now you'll never make that exactly just because the butterfly is just, really threading the needle, but you'll get pretty close to it. But you can still see huge returns. So you're risking $1 to make $9. Now in this example though, 2 days later, this trade was up $70 per spread. And then if you look at $70 on a risk of 10, that's a 700% return. So literally this one option strategy, the butterfly, out of all the other option spreads, will make the biggest return on risk of any option spread strategy. So they can even do better than 700. You can see examples of making 1,000% return because you can get your risk so low. So they're kind of, sometimes we call these kind of a lotto trade. All right, so that's the beauty of it. Now, the way that they work is they're taking advantage of that sell side component of the time decay and volatility, which at expiration will go to 0. So if we look here to the profile, you'll see how this looks. Now going out, this was set up on like the 14th and expiration was 2 days later on the 16th. So you're going to get your maximum benefit, as you go into expiration. So this one was trading, started out, it was at about, let's see, back up here, when we set this up, it was trading right about here at about 265 or so, right here. Now we, 267. And then at expiration, it was very, very close. It was going out at 273.08. So right here, you can see that purple, that's where it was at expiration. And that's the top of the profit zone or profit 10. So this went from 10 cents. So if you did one option spread butterfly here, $10 cost, and it went to 80 cents or $80. So that's your profit of 70 or 700% return. So you're really taking advantage of, that time decay, theta decay, volatility collapse, which goes to 0 and gives you a high return on your capital. So again, at expiration, time goes to 0 and volatility goes to 0, and that's where you get the big, huge payoff benefit. So in this example, just on 4 contracts, this was up $280, and the total risk per contract was $10. So it's a great way to control your risk. And so you can see that if you're in a really uncertain market where you're not sure, one headline could sabotage your trade, it's a great way to go. Now, the next one we'll look at is a wider wing butterfly spread. Now, these are really great because they can give you very defined risk, great for hedging. They're great for targeted directional swing trades, trades that last from a day to 2 weeks or something. That's kind of how I define that. Great for what we call pinning. Pinning is when you're looking at an expiration strike that you think that the underlying security could go out at. We can set up a butterfly around that. Great for high volatility markets because the higher implied volatility pushes up premium, so we get that benefit. Also, in this example, I'll show you great for high price stocks. So if you are missing out on activity of trading things like an Amazon or Tesla or something that you might want to participate in, but it just costs too much, it's a great way to trade those types of stocks. Trade duration, we can look at these trades from 1 day to 2 weeks out. Always a positive theta, no time decay, which is an obsession of mine. And they can give you returns of 2 to 1 or even 10 to 1 or higher. So here's a great example of how to incorporate a wide wing butterfly so you could trade something like an Amazon. Now, this is one that's going to be a $1,000 spread width. All right, so in this example, Amazon had traded down here to this 200 period moving average. It was just kind of churning, coiling sideways. And we were looking for a target to 1830. So we're looking, okay, how can we set up a low cost, low risk trade? So with this one, we did it with a butterfly targeting 1830. Okay, so it was on the 29th, it was trading at 1782. And then we were targeting that 1830. Now here's a couple of things about this. So if you wanted to trade Amazon and you just went out the usual customary way of just buying shares to buy shares of 100 shares, which is equivalent to one option contract, you'd be buying 100 shares of this. This would cost you $178,200 to pick up 100 shares. Now, if it did hit your target at 1830, then you made $48 a share. But on that risk of $178,200, that's a 2.69% return. All right, to me, that's a huge amount of risk for that small of a return. But we could do the same type of trade where we're targeting 1830, but we could do it with the butterfly. And in this example, with a risk of $80 per spread, or that'd be like $80 per 100, right? Because it's equivalent to 100 shares. So in this example was buying the 1820 call, and we're targeting, this is our target, the body here would be the 1830. So the 1820, sell the 1830, then sell the 1830 again, buy the 1840. So you can see the spread width is $10 or 1,000. So 10 times 100 is 1,000, less the cost of the trade, 80. Okay, so you can see the debit cost is 80 cents or $80. So the max risk is $80. But look at the potential return here. So this is a wider wing butterfly. Now, if you were to nail it perfectly, which you'll never get it perfect, at 1830 at expiration, this trade would be up $920 per spread. So if you did one spread, you're up 920, and that'd be 1,150% return. Or the other way to look at it, you risk $1 to make 11.5, versus here, you're out of pocket a huge amount of risk, and you're only getting in 2.69%. So that's a huge advantage. Now, the next thing is, the other advantage is time decay and volatility collapse, and how that is a huge advantage as well. So here, this is going out at expiration, and this is in the morning, the AM time frame. So this is to show you the huge impact that time has on this trade. So again, you're long this long call butterfly, and this was in the morning, so about 9:30, 10 a.m. Central. At that time, it was trading at 1836 right here. All right, so it was trading at 1836 at about 9, 10 a.m. Now, at that point in time, this trade was up $150 per spread. All right, so it went from $80 right here where my tool is to 230, which is 150, which is a pretty good return when you look at the risk of 80. That's 187% return. But see all that area in here? That's what's left of the value in that option spread. That's all made up of time and volatility. So it still has potential for a huge amount of more profit if this trade can get closer to, you go into the latter part of the day and it's trading in this area here, you're going to have a huge amount of potential profit left in it. So here's the same day, but this is in the afternoon. So you'll see the huge difference and impact that time and volatility has when it goes out. So here it was later in the day of the same day, the 6th, and this is going into expiration closer to the end of the day. So you can see it's almost trading the same, very close to where it was in the morning It's trading at 1832, but look at the difference between the profit now. So it went from, excuse me, $80 at this point in time, the same day, just a few hours later, it was now trading at 695 or 695. So the profit is up to $614 per spread, or that's a 769% return. So it's gone up by about 4x, from the morning to the afternoon. And see that little area there? That's what's left of time and volatility, hardly any, because at expiration, at the end of the day, those are going to zero, and that's what you're getting the big, huge advantage of, sucking out that additional time and volatility. So you went from a $150 profit in the morning to the afternoon is up to 614. So that's without doing anything else. So that's a huge advantage you get. That's another. So there's a lot of great things that you can take from using Butterfly and the long Condor. Now, the other thing that they're great for is when you're shorting. It's hard to short this market. You can see today what happens. You get a push down, then it goes back up. So when we short the markets, we've been using Butterflies because we can keep our risk low. So here's an example of a spread width of about $500 doing a put Butterfly for a directional trade to the downside. So this was on SPY, and we wanted to take a short trade, and we were again targeting using Fibonacci. I was targeting down here to this area right in here, about 285, 87 in that area, and it was trading right here at 392, and we're targeting down to about right here 387 in that area. So wanted to keep the risk as low as possible because it's hard to short the market. So we did a put Butterfly, the 390 long put, 385 short, $5 wide, 385, 380. Okay, so $5 between your strikes. So the max profit would be the 500 spread width minus your cost of the trade. That's the key. The risk is $50, 50 cents, $50. So theoretically, if you nailed it perfect, which again you won't, 385, you'd make 450. But this is how you kind of base, is this a good trade setup based on risk reward? So that would be like a 900% return. Now, we were just looking to hit our target and then take profit. So in this example, it hit our target area. So we just went ahead and closed it and made $86 per spread on that risk of 50. So that's 172% return. But if we were wrong, we still only had $50 of risk. All right, so here it is going out, and it's trading at 387.90. But this is not into expiration. That at the end of the day. So we went ahead and took it because the markets can shift so quickly. So that was a way to short it, and that made $86 on that risk of 50. So that's 172% return. So you can see it went from 50 cents to 136. So another way to incorporate and take advantage of it. Now here's another favorite. I really like the long Condor because it's very similar, keeps you really low controlled risk, but you get a bigger profit zone. All right, so here are a couple examples. This was on Amazon. Now I have a trade alert service, and this was one we did for that service, and this one just recently done. So we wanted Amazon looked like it was about ready to break out, but we wanted to keep the risk again defined because of the market conditions. So this gives you a very defined risk trade, great again for hedging, great for swing trades, gives you a wider profit zone, great for trading higher volatility markets because we can keep our risk low. We can also take advantage of higher volatility by selling options, and good for 1 to 3 weeks out is kind of the way time frame we look at. Positive theta, no time decay, returns of 2 to 1 or 4 to 1. And so here's the example that we did just recently. This was on the 9th of June. So we were trading right here, and we were looking for, Amazon had been consolidating here for about a full month, and we're looking for it to break out. But the markets have been kind of really jittery here, so we wanted to have this a very low risk trade. So we did this as a long call Condor, and you can leg in or leg out of these things really good too, which is great. So we set this up a directional trade, and so what we did was we went long the 33.35, 33.40, basically called debit spread. We do this as a spreader. You can leg into it, and then we at the same time sold short the 33.80.85 call credit spread. So total cost, look at the risk first. That's what I do. Total risk is $60 per spread. $60 would be the max you'd lose just on the spread. Now, the potential profit, though, would be maximum of 440 if it goes out inside of this zone. But, you know, the thing you have to be aware of is, you know, what you're trading. Amazon has potential to really to move fast. So we're aware of this short strike here. So we actually took profit in here because it started to move. And just knowing how Amazon works, you know, you don't want to let it roll and it rip through your short strike. So we took profits out here. But it still did really great when you look at the comparison of risk reward to if you just bought outright. So let's go through this example here. So if you had bought 100 shares of Amazon when it was trading, when we set this up at 3,290, you'd be, you know, out of pocket $329,000. And if it hit your target here, we were, you know, we got out here at 337,600. So that'd be a profit. You'd made a profit, but that would be a 2.61% return, you know, on that profit of 100 shares. Versus if you did one option contract, did a Condor here when it was trading at 33.76, you took it off there, you made $98 per spread, 163% return. Versus here, you're out of pocket 329. So that's just a kind of a thing I wanted to point out. So here is going out, this is what we call the T+1 line. That's where it is in time. So this was on the 15th, took profit there. And what we typically do, we'll scale out. You put, you know, contracts on. What you're trying to do is see if it can go out in this zone. But, you know, with Amazon, it can really fly. So we just went ahead and closed that out. So this was up $98 per spread on that risk of 60. So there's your return of 98%, 163% return. So that's the beauty of it. So maximum loss potential 60, maximum profit 440, and that's the beauty of it. All right, great for hedging. Here's one more example. This is on Roku. Again, kind of similar situation. Really high flyer, can really move. So we want to control our risk really well. So we went long Roku and did it with the long call Condor. So here's our long setup right here. It was trading at 332, and then we got out on the 25th, 28th when it was trading at 349. But we did this again as a Condor, and so we were able to really control risk. And this one actually turned out to be a max profit because it went out within our profit zone. So we risked 74 on the spread. Potential max profit if it goes out between the two spreads would be $176 or 238%. Now on the 28th, it was trading at 349, and so we were up $133 per spread. That's 180% return. Pretty nice. So you can see here, 74-cent debit, 207 is where it was trading. But then on Friday, it went out within our spread zone, which was perfect. So it maximized the full trade. And on expiration, that was up then at 346.72. So this was max profit of $176 or 238% return. So that's the great thing that you get out of it. Controlled risk, but potential for big, huge returns. Great way to hedge as well. All right, so 74 max risk, 176 max profit. Now, here's another great example of how you can use this for hedging. And what I always look at as well is, can you improve or adjust your trade to make it better? So it doesn't necessarily mean you're hedging it to hedge against potential loss, but you're hedging to maybe make the trade better from either more profitable or reducing your potential theta or time decay. So here's an example of doing a put spread, debit spread, a long put debit spread on SPY, and then we adjusted it to a free trade into a long put Condor. So here was the trade. It was trading right about here at about 275, and we were looking again for a Fibonacci target down to about 270 in here. So the original trade we set up was just a put debit spread, the 273 put, short the 270, so $3 wide. So $300 spread width minus your cost, 65. So really nice trade setup to start with. Maximum risk 65. If this was to close below that 270, you'd make $235. Great return, over 300%. But the problem with shorts, they don't tend to stick for very long. So the way we did this trade was it hit our profit area. So you take profit on part of it. So that was $98 per spread. Nice return, 150. But we had the opportunity actually to convert this to a Condor, and we converted it to a free trade because we sold a credit spread side and brought in $65 credit. All right, so the original trade was the put debit spread, and then when it flushed down to our target zone of 270, we were able to sell the 268 put by the 265 bull put credit spread for $65 credit. All right, so that offsets the cost of the debit spread side. Now we have a free trade. All right, so we have the debit cost of 65, credit 65 in, zero risk now, and we could just sit back and relax and see what happens. Now, if it had gone out and between the spreads here, this would have been $300 profit on zero risk, but it was closed out right here as trade about 271.33, so it's up 164, but on zero risk. So if you look at the two, trade one made $98 or 150% return. By that adjustment, the balance of the trade made 164, but we had zero risk. So it's just a great way to kind of utilize options and take advantage of them. And if you'd like to learn more on how to kind of master these high reward, low risk strategies, I've got a great package for you today. And if you'd like to take it, it's $97, but you're going to get my option butterfly condor course that I did. I did this in January, so it's a pretty relatively new course, but it's a 7-hour, 6+ hour, actually turned out to about 7 hours. And it's just strictly on the butterfly and the long condor. So it's butterfly long condor master's course. Now, you're also going to get some great bonuses here. You're going to get, this is everything you'll get. You'll get the course, which is recorded and broken down in modules of 30 minutes or less. So like a chapter of a book. So you'll get this course, which is strictly on the butterfly condor. And then you're going to get my options beginners course, which is a new course just more for beginners options, which will be a great way if you're just starting out. A nice complement introductory to this. So these are yours forever, though. The 97 is your investment, but these courses will be given to you. You'll get a password so you can log into the website at Power Cycle Trading and access your course material, which will be on the web, on the cloud, I mean, all the videos and the PowerPoint. And my courses are very detailed. So you'll get the options beginners course, and then you're going to also get a trial membership. You'll get 30 days trial membership to my trading club. So this will give you additional support to come in and ask questions about the course if you have any, or just come check us out in our trading room every day to see what we're doing and ask any questions you have on any of your trades. So you'll get that as a bonus. Then we'll do a live support Q&A follow-up. This will be about a week later, and you'll get an email on that to join us for Q&A. You'll get my option trading tutorial, just basically another option course on the Greeks and probabilities. My option strategy manifesto, so another 15 option strategies, how they work, and my Greek power tool guide, which is a printout you can put on your desktop of the, the various Greeks. Okay, so everything here for $97. Now, if you can start the trading club whenever you want. You don't start it right away. Just send us an email and we'll start your time when you want. And then if you decide to stay with us, it's $97 a month, or you can do an annual membership for $488. So again, you're going to get the Options Masters Butterfly course, 7+ hour, 30-minute modules, videos, 456-page training manual, PowerPoint, so very detailed with lots of trade examples. So it's my blueprint course, I call it. So I go through how it works for income and different directional trades and hedging. So basically, the part one starts out with the Greeks, how they affect the butterfly, the various delta, theta, things like that, theta decay, how that impacts volatility, the impact of that, how option pricing works, using Fibonacci for what we call target mapping and standard deviation to map out your price targets. And then part two is the core basics of how these work. So most traders don't understand them, so this will clear that up for you. And then I go into great detail how, why, and when to use every different variation of a butterfly. So really great with trade examples. So go through exactly how, why, and when would you use a call or put butterfly, a wide wing butterfly, a broken wing butterfly, the ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So a lot of great stuff here. So you'll understand each one of those different variations, and then you can select the one best suited for the market condition. Then we go into what time frames to use, what to use these on, stocks, ETFs, how to structure these to get those big 10-to-1 or higher, how to use these for option volatility collapse and theta decay, And then we go into another section of the course is just for option pinning, monthly expiration. So how to use it to, for a pinning trade that can give you an additional kind of income stream because the monthly expiration 12 times a year. So these are also a lot of fun. And these are what we call kind of, a lot of times these can be the kind of the lotto trade because you can keep your risk super low. And if you pin it, at a certain strike, you get a huge payoff. And then go into the long Condor, the advantages, when to use it, for your returns and to give you low capital risk and positive theta on that, but the bigger profit zone. So how, why, and when to use the long Condor option spread. And then a big section of the course is dedicated just to hedging, because they're the best way, the only way that really to use options for hedging that I've found. So how to use the butterfly and long Condor to hedge a core position, or how to use the butterfly or Condor to hedge and defend a vertical debit or credit spread. So it's a really great course, lots in the course, and then all the bonuses are great here for you as well. So you also get my resource chapter here. So what is assignment risk, expiration, how that works, auto exercise. And then I add a trade library so you can look back at other trades and get an idea how they work. So a little feedback on this, this from one of my members that took this, said, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like this. Wish I had found you sooner, but glad I found you now. Thanks again for your time, Alicia. And this was from Pam, who had been getting killed on credit spreads. Excellent class, Larry, as usual. You under-promise, over-deliver. Wish I'd known how to do this hedging before I lost so much money on those credit spreads. So here are your bonuses. You're going to get the option trading for beginners course. This is a new course on beginning options. So the benefits of options versus stocks, puts versus calls, option expiration, how that works, beginner option strategy, a covered call, how that works, how the covered call with the protection, the collar, what we call it. This is a great strategy too, just in general. So you'll get that course, and then you'll get a trial membership 1 month, and you can stay in 30 days. And then if you want to renew, $97 a month or $488 a year if you'd like to do that. So here's one of my members, just really happy to see how Richard's succeeded here. He said, today I got back to work full time. This is about 3 weeks ago. I guess he gave me this. Today I got back to work full time at Mandalay Bay here in Vegas. They shut us down April of 2020. He said, Larry and his trading services helped me survive the last year. And Richard said, then again, said, Larry, I wanted to thank you. I'm glad I found your service. I'm learning so much. And then Jay, this is really true. He said, just kind of the long and short of it is, he's really learned a tremendous amount on option trading, but he said reading books is fine, but seeing the actual option trade makes a huge difference. So that's a big advantage. So you'll get access to the virtual trading room every day during the week, 9:30 to 10:30. I'm in there hosting the room. So if you have any trading questions or you can see what we're doing, you get a daily video newsletter update every day after the close. They're archived. We do a Q&A every Tuesday, which is live and recorded. Educational material that's free in our vault for the members, and you'll get 60% discounts on everything on my website, on all my courses and software. All right, so you get that, and then with this you'll get the bonus follow-up Q&A. I'm about out of time here. My option trading tutorial goes through the Greeks, probabilities, and my option strategy guide, 15 different option strategies, back ratio, spread, etc., and my Greek power tool guide. So a great package and a great course, and it'll pay you 10 times the amount of your investment in a short period of time. Oh, hold on, I sent it to the wrong. Here's the link again. Sorry, use this link here. PowerCycleTrading.com/1EX. PowerCycleTrading.com/1EX. Okay. So these are spreads, so you're not selling naked. So you're not going to have any problems with your whatever trade account you're using. These are all just spreads, so you're not naked short. So there's the link. Everybody get that link, okay? I didn't realize it was not going to everybody. Okay. Any other questions before I'm out of time here? Well, again, thanks everybody for being here, and look forward to working with everybody in the future. So take advantage of this, and good luck trading.
Good morning, everyone. This is Sunny Harris, and today we're going to talk about what's this I hear about futures, also known as futures trading for the uninitiated. And I have a little song to play for you this morning. This is the theme song to Money Mentor. So that's I had that composed for me years ago. Money Mentor is "You're in the Money." That sounds good to me. So no one helped me get started. When I started, I kept copious notes of everything I was learning. I read every book I could get my hands on. I learned everything by asking questions of other traders and brokers. In this black book, I kept all my contacts and their information, which became Trader's Catalog and Resource Guide, which I published for 8 years from, I guess, 89 to whatever, 97 or 96. And I went to every seminar I could, and I bought every course in every strategy. In fact, I paid $900 once for a course for a strategy that was a printed 9-page document telling me that when the RSI and the stochastics were in disagreement with the market, that you should be ready for a trade. So $900 for just that. So all my notes on the steps I took and all my resources and everything a beginner needs to know to get started, I put in my first book, which was Trading 101, How to Trade Like a Pro. My passion is in helping beginners and intermediate traders who want to learn about futures, want to learn about trading, want to learn about technical analysis or programming with easy language. This talks for traders who haven't tried futures or haven't traded much and want to learn how. So all kinds of beginners and folks who want to know how I trade, because I'm going to tell you that too. So I am a trader. I've been trading for 40 years. I trade futures, stocks, ETFs, and crypto. I do not trade options. Sorry, Larry. I only know how to lose money with options so far. And I'm going to tell you a bit about myself, but first let me show you how I trade. So I trade the S&P 500 futures contract, the E-mini, not the micro, and I trade it on 1-minute and 5-minute charts. My long terms are stock holdings and ETFs. I hold them a week or more, and the crypto I'm holding for the long term too. Here, for instance, is a chart of Bitcoin. You can see this first vertical line out here on the left shows a perfect place to go short. And it was called by I call this my dynamic moving average histogram on the bottom. So the DMA H called that position right there. It went short, 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 short. And then right here at this next vertical line, it said go long. So Bitcoin's right up here now at the DMA lines, the purple and the gold. So all it needs to do is break through that. I didn't look, this is yesterday's chart. I didn't look today what's happening, but if it'll break through that DMA, the DMA will turn around with gold on top and we'll be headed for higher prices. So let's talk just for a second about ETFs versus futures, because if you don't want to trade futures, you can still trade the S&P. So there's a symbol for the SPY, there's a symbol for the E-mini, and this, well, sorry, this is Spiders, E-mini, and the SPY itself. And you can see they pretty much turn the same time, same place, and they're just almost identical. So if we agree that they're pretty much the same except for the price of entry, let's look at the predictions. So this is the chart that I look at all day long. It's a 1-minute chart of the E-mini. It's got 2 sets of sunny bands on it, a lighter green and a darker green for the bands. In the middle is a gold line and a purple line. That's my DMA. When that, as a macro view, when that thing crosses over with gold on top, it's signaling that the market's long. When it crosses over with purple on top, it's signaling a short. But again, I said macro because I know things about what the market will do. For instance, right over here. Can you see my mouse, everybody? Where's the chat room? Chat room dashboard. Oh well, I can't see it. How to chat. Hang on just a second. Chat. I don't see it. Oh well, so I look at the DMA on the bottom, DMA H. This thing turned green back here. It was going purple and green, purple and green, purple, and then it turned solid green. So that's the place I would go long. But look, I'm going long against the DMA, which is purple on top. So I can go long from this position up to here, and I don't expect, unless it changes color with gold on top, you don't expect it to go any further than the DMA with purple on top. But then it switches to gold, and sure enough, goes all the way up to the inner or the outer upper band. Except this is the 1 minute chart. This light green one on the top and the bottom is from the 5 minute chart. So I have two data sources on here. So 5 minutes is my long term, and 1 minute is what I'm trading from. If you want to get this kind of insight for free, then you can sign up for the free Sunday night sunny side of the street, which goes through the sunny bands and the DMA-H's on several different markets and has a little bit of commentary. There are lots of hyperlinks in this presentation, so and I kind of have to go fast today because this is an hour-long talk I'm giving in 45 minutes. And if you want to click on these things, you'll see sunny side of the street. You can go right there to the sign up, and if you want me to send you a PDF, I'm going to, actually not going to send it, I'm going to link it on moneymentor.com under appearances. I'll put the PDF of the slide there. So click above to get on there, and you can see here, you can go to moneymentor.com and click on, where is it? It's over on About. It's with appearances. I don't know why I said that. I've been rated #1 trader twice when I had a hedge fund back when, with 365% and 178 respective profits, which put me on top. And I was using sunny bands in my DMA to do it that long ago. And here you can see Rourke International was my trading company. It's right there on top. A little bit about my credentials. I've got degrees in math and photography. I've been programming for 52 years and trading for 40. I was a systems programmer for Lockheed. I founded ISCO, the world's leader in computer graphics software. We made, among other things, Harvard graphics. And then I retired at 30, gave my millions to money managers, which was a real bad idea because it took them 3 weeks to lose 75 grand and another week to lose another 50 grand. And I said, that's it. I can do that poorly on my own. So I taught myself to trade. I read 117 books. Now I've read over 400, but that's where I started. And I did not enter a single trade for the first year of watching the market. My little black book became, as I told you, Trader's Catalog and Resource Guide. I did that for 8 years while I was trading. And I've been consistently rated in the top 10 by Stocks and Commodities magazine. And what else? Books. I'm going to go through this fast. As I said, you can see this on the PDF if you want. I'm working on grading the gurus right now. But if you want, I've got a voting place on this in this presentation where you can vote on which book you want me to write next, because I've got 5 of them I've started, and I'd like to get some direction and pick one. So Stocks and Commodities, I've written articles for all these magazines. Coming up on another one for Stocks and Commodities and another one for Traders World magazine. There are my books, real quick. And this one, Using Easy Language 9.x, I wrote with Murray Ruggiero. And it's a really good, if you want to learn easy language and get some good coding tips, it's there. So here we go. What do you want me to finish? These are the books I have started. And you can click here to vote which one you want. It goes right to there. And when you're there, click on Quips and Quotes. It's over here to sort of to the right of the menu pull downs. And you can read what other people have said. And it goes page after page after page of people telling me about the book and the indicators and all that stuff. I do post for free on my Sonny Harris Facebook page. I post what I think the Dow and the E-mini are going to do. So go to Facebook and look for Sonny Harris, or you can opt in to the free Sunny Side of the Street here That's what sunny side of the street looks like. And well, I've called for rising markets when others were calling for a crash, and corrections when everybody else was buying. But my views aren't always the same as the pundits. So check out the new money mentor, please. So what are futures? They're also known as derivatives because their value is derived from the underlying, whatever the underlying is. So with the E-mini, the underlying is the 500 stocks in the S&P 500 index. They're not like stocks in some ways, but they are like stocks in others. For instance, if you own a stock, you own a small piece of a real company, and you can hold on forever. Stocks don't usually drop to zero. But if you trade futures, you're buying a contract to take delivery of a commodity at a later date. And yes, you could lose more than your initial investment. You can buy stocks, and if you want to set up a margin account and the stock is borrowable, you have to look that up, then you can short them for half. Usually they give you half margin on half of the amount of money in your account. So if you trade futures, though, you will have a margin account. You're borrowing money from the exchange or the broker. I'm not sure which. And let's talk about shorting, because you can short futures easily. Long is buying in hopes that it'll go up and you can profit, but short is selling something you don't own on the promise that you'll buy it back later, and that's on the hope that it's going to go down. So here's what long trades look like. This is the Dow, which is not tradable itself, but that's where all the long trades are on that chart. And this is what the short trades look like. So you go short, hoping it will go down. Now, why did I put quotes around that? And that's because you can't really trade the Dow Jones index of 30 stocks. It's just a measuring stick. So to go long and short like that, you need a tradable instrument. And nicely, these days, there's a futures contract called YM that you can trade. That's the YM is the Dow, but it's a future contract. So if I put YM on the chart, that's what I get, nothing. And then why did that happen? Because futures contracts expire on a regular interval, usually every 3 months. And in order to view the symbol on this chart, you need to know when it expires, and you have to use the code for that month and year. And for instance, if you go to the CME.com, I think, Chicago Mercantile Exchange, you'll see how symbols are constructed. And if you go to moneymentor.com reference, you can see symbols there. There's all kinds of things in this reference. All right, so the reason is because futures contracts expire every 3 months, or sometimes more often. There are other futures that have more symbols than I use. And the history behind that is that futures used to be crops and animals. So you were selling a crop that you just planted, and you're selling it for the price you want to sell it 3 months from now when it matures. Same thing with animals. Every 3 months they were born and matured and came to market, but you could sell it before it was ready to come to market, and that is a futures contract. So the expiration months codes are these, and those again are on the Money Mentor. But the most important ones for me are HM, U, and Z. I have those memorized from a long time ago because we just, for instance, left the M contract in the E-mini and moved to the U, which is the September, as we passed the June expiration date. Okay, now, so YM is for the September, the current expiration month for YM is September, since June has passed. So the year is 2021, and we'll construct the contract this way. YM is the contract. U is the month. I didn't get that changed. And 21 is the year. So now we have a chart. YM, I made this chart a few days ago, so it's the YMM, but it's same as the YMU. What does delivery mean? In the old days, exchanges actually physically delivered the commodity to your doorstep. And in fact, they do still for some contracts. But for others, like the E-mini, they simply cash you out of your position, win or lose. So whatever you're in, if you don't flip it, they're going to cash it out. Imagine a herd of live cattle showing up on your doorstep. That used to happen. So there's something called rollover and expiration. You must remember this date so you don't take delivery. Expirations on the third, for the E-mini again, everything I'm talking about is for the E-mini. It's the third Friday of the third month. So that's the expiration month, HMUZ. But rollover is the Thursday of the prior week. And that's when everybody turns their contracts over from the current month to the front month. So they roll over on the Thursday prior to the third Friday of the third month. And that becomes front month. And I have it on my phone, and I had an indicator both that tell me, what's that? Sorry about that. That tell me it's time. See, I've got rollover permanently on my calendar and also expiration. Let's talk about technical analysis of Stocks and Commodities magazine for a second. In the back there of that magazine, every month, they put a futures liquidity table. And at this table, you can see that the S&P is right on top. You can't read that really, but the S&P is right on top. It's usually the most liquid contract. And you see these stars that go out all the way over. They measure how much liquidity. So that's the most traded. The 10-year T-notes, the next most traded, and the NASDAQ E-mini, for instance, some people like that. It's down at 7th in liquidity, but it still has plenty of liquidity. YM, the one we were talking about for the Dow, is 19th down there. I wouldn't trade that one. I wanted to tell you about the Dow and the possibility of trading it, but I wouldn't trade the one that's down on the 19th, because you don't buy something you can't sell. If there's not enough liquidity, you're going to get a bad fill. So how does the YM compare to the Dow? Looks to me like they're just almost the same. Not quite. If you look out to the far right, the Dow is right here just barely moving up, and the YM is doing a better job of having more trades and more excitement. Here then is the E-mini versus the Dow, and you can see that they are virtually the same too. They're not mathematically the same, but the turning points are very much the same. You can see that. So when you're trading stocks, you pay the value shown on the quote. For instance, Google costs $231.81 per share. I don't know what it costs today, but that's what it was. And Microsoft was $247 per share, and that's what you pay for. You pay for what you see is what you get, unless you have a margin account, where then you're trading on borrowed money and there's leverage. That's a mistake in the presentation. But futures, oh, I see what I'm saying. Unless you have a margin account, there's no leverage. But futures are leveraged. So you'll be trading them on margin. I trade through TradeStation, and these are the most recent futures margin rates. You'll see the E-mini has a $12,000 initial margin. So if you want to trade one contract of the E-mini, you've got to have a minimum of $12,100 in your account. But if you have a losing trade as your first trade with that much in there, you'll go underneath the initial margin, and then they will get a margin call. So if the S&P is trading at 4,200 and there are 500 stocks in the index, that means that the one share of the S&P is actually $2,100,000. But for 1,200, you are controlling over $2 million worth of asset. So the margin rate then is just 0.6% that you're putting up. It's pretty steep leverage, actually, if you think about it, because when you buy a house, you're putting a 10 or 20% down for that margin contract. People think futures are risky because they're leveraged and you can lose all your money. And that's not quite true, because what you can lose is more than is in your account. You get a margin call for extra, but you can get out at some point, and you usually don't lose all of it. But you could lose a lot. So you've got to have enough money in your account to cover a loss, or you will have a margin call, and then you can lose more than is in your account, but you have to pay the difference. Usually the broker will call you or send you a notice by email that you have a margin call, and you have to bring the account back over the margin rate with 24 hours. I like to trade with double the margin in my account for every single contract. If you're sitting on a losing trade, this could lose you a lot of money. You don't want to be sitting on losing trades anyway. That's called investing, not trading. So you have to give it up because you can't hold it forever until the market turns around, because it expires every 3 months. So it will expire on you and it will be a losing trade. You know, what if the rebound takes a year to go back to your price, but it's expired 4 times since then? So let's talk for a second about how much can you make trading the E-mini. It's got a $12.50 tick and a $50 per point value. So if you're trading at 4,200 and it goes to 4,201, and presuming we're long, then you're going to make $50. That's not much of a move for the S&P. It moves a lot more than that. So let's look. That was a mistake too. Here, for instance, I've drawn an orange line, just measuring this short trade right here, and it's 3.58 points. You can see in the orange right beside that dot. So 3.58 points is $179 in 4 minutes. This is a 1 minute chart. So 4 minutes, we make $179. That's not bad. Here's I've highlighted all these trades in the E-mini, 1 minute chart again. And if you trade that one, they were 72 points or $1,000, $1,080 that day, trading one share. Of course, you're not going to catch all those, but I have an indicator called PHW. Let me go back just a little bit. Potential hourly wage is see the red and the blue dots on this? Red dot means you should go short. Blue dot means you should go long. Of course, they're all placed at the perfect position because this is actually calculated after the fact. You can't know what the exact turning point was until it's actually turned. But this keeps me honest. These dots keep me honest and keep me knowing, am I trading where I should be trading, or am I doing wild trading in the middle of dots? You didn't do anything except where the dots are. Okay, so that was my PHW. And it measures these things and gives you how much you could make at the end of the chart. This is what my sunny bands look like on that same chart. And this is like next to impossible to read because it's so squished up. But you can see here, short, 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 this thing's staying under the band, hanging on to the bottom band. Then here it bounces up and it goes all the way to the next band and then bounces down again. So let's do something we can see. It's not so squished. All right. In the middle, we've got the dynamic moving average, purple and gold. And that's my macro signal for which way I want to be trading. Gold on top means long, purple on top means short. So I trade as price continues down under the DMA, it bounces down here off the sunny band. See, it comes up, and then it goes back up, 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 up to the next sunny band on the top, touches it, turns around, and comes back down. So it's just constantly trading from one side to the other on my sunny bands as they go up and down. It's just easy. So this is if you watch the DMA crossovers. DMA again is the purple and gold. You'll see where it signals long and short. Now those are pretty good trades, but they're not perfect. They're late. So that's why I say it's the macro look. And this one is if you watch the penetrations of the sunny bands, and you can see we go long, short, long, short. I'm lost track. Short, long. Let's go back to that one just a second. So these are the trades that are signaled by the sunny bands, and they are more accurate and faster than the DMA, but I still want to know where the DMA is because the propensity is for price not to go beyond the DMA on the downside if the gold is on top, and vice versa for purple on top. So does the S&P ever go to zero? It hasn't in the 40 years I've been trading. But if the world came to an end, yeah, it might. And then you'd have worse problems than that. Biggest drop I've ever experienced in that time was the 1,100 points during the COVID crash. But luckily I was short during that time. So you can't hold on to a futures trade waiting for a rebound. Just remember that. Now there are also limits in place so that you can avoid crashes in the market. From Investopedia, you can see that there are daily trading limits. I'm going to let you read this later on my PDF that I post to my website, or you can see the presentation when Anna records it and posts it. But those are definitions that it's important to know. Yes, and I even sell you the strategies that I use, indicators I use. I don't sell you anything I don't use because I didn't program anything I don't use. So the things that I've programmed and offer for sale are the things that I use in my own trading. And I will teach you exactly how I trade them. We spend time on the phone and with me on your computer until you get it. And these are the same things that made me the #1 trader years ago. So that's the macro clue, the DMA, but that's not enough. So I created Sunny Bands, which is faster. And we click on that and we go over to see the products and services. And then this DMA histogram, DMAH, is even more precise. And you can see it down here. The gold on top means we're rising. When rising, it turns to red and moves down. It's time to go short. Rising, time to go short. Rising, time to go short. You can see this in the gold and the red. Every time it changes color, then it's signaling the opposite trade. I do wait. Oh, let me go back. I do wait for higher highs when it signals a long and lower lows when it signals a short. That's the only caveat there. Okay, so you get signaled the direction, but then you want to confirm the direction. So let's look at those turns on. There are the turns on the DMAH, and you can see how incredibly precise that thing is. And that's all there is to it. I look at the attractors. I look at vantage point, which I think I have a vantage point chart coming up. I studied the dynamic moving average and the Sunny Bands. I trade on 1 and 5 minute charts. I trade many times a day, like 15 or 20. But with equities, I buy and hold for weeks to months. So the next step is to look at the 5 minute chart to see what the long term is. And this is tricky to put two charts together. So if you want to do that, you can go to YouTube, my YouTube channel, and there's a video there that tells you how to do 2 data streams on 1 chart. So like there. And that's what it looks like. So I can see 1 minute Sunny Bands following the rules. So the Sunny Bands themselves on the inside are following the rules of the outside Sunny Bands. So and I colored them different colors. The 5 minutes, the light green, and the 1 minute is the darker green. And of course, it works on any time frame. I mean, you can even see there that it's just been up on top of the DMA this whole time. So for us to get a serious crash, it would have to go down through the gold and purple and down here into the light brown and magenta area. And it works on any symbol. There's Google. Then every night before I go to bed, I consult Vantage Point to see where it might go tomorrow. And the gray bar on the right is the Vantage Point chart with tomorrow's forecast. And you can see, I have to move this out of the way. Well, it's on the far right. I think that the command post is in the way. So it's on the far right. There's a gray bar that tells you where they think tomorrow's going. And I do check that out every night. So I look at Vantage Point. I draw attractors on my charts. I put Sunny Bands on the charts in the DMA H, and then I read the signals, take the trades, and make money. Can't be any more disciplined than that. If you're doing it right, trading is boring. If you're excited and getting all wumped up, it's usually because you're making losses. So about a week ago, maybe it's a week and a half now, I launched my newly redesigned and programmed Money Mentor. I'd like for you to take a look at it, pretty please. It's way different than what I had up there before. Took me almost a year to program it. So I'd like you to take a look and give me some comments back. I've had it on the web since 1995. It was one of the very first websites up. There are only 10,000 people on the web in 1995, and now there's 4.7 billion, I think is the number. All kinds of trading resources in there. So there's the website, so you know when you get there. And then you go down the website and you can see today's charts for the Dow and the SPX. Every day they're updated 15 minutes delay. You can see the Vantage Point prediction on Money Mentor for free. You don't have to buy Vantage Point right there unless you actually want to see it on other things besides. Sometimes I put the Dow up there and sometimes I put the E-mini. And you can see that I have consulting and mentoring packages. And here are some quotes in the middle. Thanks to Sunny Bands, I have a net worth above 1.25 million. Don. Don started with 25,000 in his account and then sent me this when he got up to 1.25 million. I talked to him not too long ago and now he's up to 2 million. So that's Sunny Bands for you. Here's one that says strategies have produced 10 positive trades in a row. And this one says, thank you for TradeStation Made Easy, which is the book that I wrote. Products that I have were all developed for my own use in trading. They're not developed to sell. I didn't say, well, what else can I sell? I decided, what can I use in my own trading? And then I make those available to you and I show you exactly how to use them. And you can click on this link to go see everything that I have, and I don't hold anything back. I tell you exactly what I do. Here's the order form so you can see where you can buy consulting and mentoring or any of my indicators or correspondence courses or anything I've got. Special offer for you today only. Yeah, I think I'm almost out of time. Anything you order before the end of this week, today's Thursday, so let's give it through Sunday night. Anything you order this week will be 40% off, everything. Or if you order before the end of the month, it'll be 30% off. So you get an extra 10% off if you give me a call or order something currently, and I'll be happy to give you a trial if that's what you're interested in. And it even includes my time. So if you want a free trial, call me at this number or email me. And I need your customer number and for multi-charts, your user ID so I can set up the trials. I'll send you any of my indicators or strategies so you can play with them for a week. Okay, how am I going to see the questions? Let's see if I can see questions. I don't see what the question is. There's one that says thanks. But if anybody has questions, post them to the question area. I'll be happy to answer them as I can. There's no stupid question. All questions are good because if you have a question, probably another 10 people have a question too about the same thing. But please vote for me. What book do you want me to finish next? I don't know where to turn, so give me a hint here. Vote. You can click there or back on the other slide. Click to vote for which book I should finish writing. Thank you ever so much, Anna, for hosting the event and for the audience for your attendance. Here's my contact information. And don't hesitate to call or write.
Sunny, let me help you with the questions in here because we have
Yes,
a few.
please. Yeah.
So the hyperlinks don't work from the PowerPoint, but we fixed that by going to your website and bringing them into the chat box, so no worries about that. Do your indicators work with Ninja 7?
Do they what?
Do your indicators with Ninja 7?
No, they work on TradeStation and multi-charts.
Okay, thank you. Somebody asking, are you in San Diego?
Yes, I am.
You
want me to have coffee? Does somebody want to have coffee?
And another one, can you tell us more about your trading room?
My trading room? I don't have one. I trade. I don't have a room where I talk about what I'm doing and show my trades. I just trade.
Can we get the link to special offer? So
can you get something for the special offer?
Can they get a link? Because we can't.
Oh, sure. All you have to do. Let's see where we can go here. Go back to. Come on, computer. Let's go back to the link. All you have to do to get the special offer is you click on order, and then you order whatever you want. And when you're through, you add it all up and take, if you do it this week, 40% off. If you do it next week, you can take 30% off. And that will be in the ordering, which is here, add to cart, add to cart, add to cart. And then when you get done, you take off your 40%. Does that help?
Yeah, sure. Can we, is it in products and services? Yes?
Is it a product what?
Is it in products and services on your website?
Yes.
Because we can't click through the PowerPoint.
You can't see through the PowerPoint?
No, we can't click it, you know?
But you can't click it.
Yeah.
Well, you'll be able to click the PDF when I put it on my website. But you go to moneymentor.com and click on order.
Okay, great. The webinar.
Here, right here, it's order form. You see order form? Go back home. All the way to the right, it says order form. And there you are. So just go to moneymentor.com. Okay?
Okay, thank you. So I'll send a recording of this webinar to everyone, including the link to PDF file, and you will be able to go to the website.
Excellent. Thank you, Anna.
Thank you so much, Sunny.
Are there any more questions?
Nope, not yet. But
oh,
in
here's
case,
one. Here's one, Anna. It says, do you have to buy Vantage Point to use my package? No, absolutely not. Vantage Point's more expensive than my package. Everything I have, I think, is cheaper than Vantage Point. And if you want to look at the single prediction for Vantage Point tomorrow, you can always look on Money Mentor. It's right there on the front page. But if you want Vantage Point for yourself, so that you can see other things besides just the Dow or the S&P, you can see stocks and everything, anything. So then you click on Vantage Point on my website, wherever you see it, and it will take you right to a little free course, little video that you can see exactly how to use it before you buy it. So no, you don't have to buy it. Was there anything else? I don't think so.
So, all right, guys, welcome to today's topic, the secret to beating the market using relative strength. So I'm going to go ahead and play a little video for you, and hopefully the sound will come through. If not, we'll just kind of skip over that. All right, apologize. I just saw Anna's message that the audio was not coming through on that, but hopefully you were able to view that okay. As it will tie into our topic today of beating the market using relative strength and how to pick the top stocks in any market. So again, apologize for the audio issues there. Sometimes that can be a bit tricky on the webinars, but let's go ahead and get started. So just to give you a little bit of background on myself before we get into today's topic. My name is Jeff Tompkins. I have 22 years of experience trading the stock options and futures markets, and I received my professional training at Morgan Stanley, and I'm the founder and chief investment strategist of Altos Trading. We currently have over 50,000 members in over 100 countries across the globe. I'm also a professional hedge fund manager at Altos Capital, so I do manage money for my clients using some of the strategies that I teach in my educational events like today. And I'm also the founder and manager of some of the top performing options and stock alert services out there in the market. So before we get into the fun stuff, I'll read a quick disclaimer. We all know that trading securities and options involves risk. And of course, prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options and do need a broker to trade securities and must meet suitability requirements. We will be going over some trade examples and things like that today, as well as some past results. And just know that we don't guarantee that any past results will mirror or indicate future performance. And due to the time critical nature of trading, brokerage fees, activity of other subscribers, etc., we don't guarantee that anything that we share or any of our past track record can be mirrored in the future. All right, so by the end of our session today, you'll discover how to gain the extra 1 degree trading edge that can put you ahead of some of the best traders and investors in the world. So whether you're just starting out or you're a seasoned pro, this is really must-have information for today's markets. And for those of you out there who are currently trading and investing, you'll of course know that we're in some fairly unique market conditions with a global pandemic, a new administration in office, and really a lot of volatility in the market with the VIX above 20 for most of last year and into this year. And it's finally sort of subsided down below 20. And that indicates current lower levels of volatility, but also a higher risk of volatility spikes in the future. So what we cover today will help you deal with those and manage those and trade more confidently for yourself. So let's talk about the 212 degree difference. You saw in the video that at 211 degrees, water is hot, but it's not doing a whole lot. It's just standing still. And like most stocks before they explode, they're just kind of sitting there, maybe moving sideways or flat and not doing a whole lot. But just like with water, as the temperature rises 1 degree, it starts to boil and it creates steam that can power a locomotive train. And this extra 1 degree difference is what changes still standing water into boiling water, creating steam. And it's kind of like when a stock starts to outperform a major benchmark index or sector and then skyrockets. So it's an interesting analogy to apply to the markets. And we're going to use a particular indicator to gauge that extra 1 degree difference in strength. Now, typically, when people look at relative strength in the market, they use a common indicator called the RSI, or Relative Strength Index. And so this is a commonly used indicator across retail traders as well as professional money managers. If you guys haven't used it or aren't familiar with it, it is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions of a stock or really any asset that you're trading. And it's displayed as an oscillator, so it's a line graph that moves between two extremes. So it is a bounded indicator. It has a minimum and a maximum of 0 and 100 respectively. So it was originally developed by J. Wells Wilder, and he introduced it in his book in 1978, New Concepts in Technical Trading Systems, and he designed it to help traders and investors determine when an asset is overbought or oversold. And in terms of interpreting the indicator, and we'll look at it on a chart here in a second, the traditional interpretation is that values of 70 or above indicate that a security is becoming overbought or overvalued and might be primed for a trend reversal or a pullback in price. And then conversely, an RSI reading of 30 or below indicates an oversold or undervalued condition. So this might be when most traders who use the relative strength index indicator would look at entering the market with a long position or buying the asset that they're analyzing. Now, there's a couple problems, and they're fairly significant problems with the relative strength indicator. Problem number one is that stocks can remain overbought or oversold for extended periods of time. So if you've ever used the RSI and tried to use it as a trend reversal or overbought, oversold indicator, you probably encountered a situation where when the reading was oversold or 30 or below, and you bought into the asset, that it would continue going down, or conversely, it was overbought and you were shorting or even exiting a long trade, the underlying security continued to go up. And it's kind of that old John Maynard Keynes saying the markets can remain irrational longer than you can remain solvent. So just because an oscillator or an indicator tells us something is overbought or oversold, even if that's an accurate assessment, it can remain that way for very long periods of time and can eventually wipe out profits or even our entire trading account, which unfortunately happens all too often. So this is the main problem with the RSI. And let's take a look at an example of that, and then I'll show you how we can solve that problem here in a minute. This is a daily chart of Tesla, ticker TSLA. Hot stock right now. It's been on a wild ride, certainly a volatile one. And if we look at the chart, you'll notice on the left-hand side, starting in about late August, the stock was basically flat. It was kind of ranging between $40 and $50 a share. And you'll notice the RSI indicator plotted on the bottom of the chart was sort of bouncing back and forth, between 40 and 60. And then by about the third week of October, it started to rise above the 70 overbought level. So you can see there where the RSI turns red, the stock is overbought according to the relative strength index. But as the RSI gives an overbought reading, the stock is actually going up, and this is very common. And then if we look at the December through January RSI reading, same thing, right? It's over 70 for a good couple months there. And what's happening to the stock when the RSI is telling us that it's overbought and primed for a trend pullback? Well, it's going straight up and went parabolic and rose from about $40 a share up to about $190 a share. So the RSI gave us false information telling us the stock was overbought when it actually was going up significantly. This is another example. So this is Best Buy, and you can see the stock's in a strong uptrend. And if we look kind of in the middle of the chart in the July timeframe, we have a significant overbought reading over the period of July and August. And we have a couple other overbought readings earlier in the year in April and May, and later in the year in September, October. And once again, the RSI misled us as the stock shot up from about $70 a share to $120 a share. So this is unfortunately all too common with the traditional RSI indicator, is it gives us false readings. And it makes it very difficult to time trend reversals or trend pullbacks or overbought or oversold conditions when used alone. Here's another example. This is Amazon, another hot stock right now. If we look at the RSI in June, it spent a significant amount of time up near or above the 70 level. Same thing in July, hovered above 70 for a good part of the month of July. All the while, the stock is going up from around $2,400 a share up to over $3,500 a share. And the RSI actually never dipped below 50 during this entire time period. So again, gave us misleading information and would have made it very difficult to trade these types of setups. So I'm going to show you a different way to use relative strength that I found to be more accurate and give a much better edge of in terms of when a stock is starting to outperform. That 1 degree difference between a stock that has kind of been trading flat and is beginning to break out and go into a strong uptrend. So this is Amazon once again looking at it, but instead of looking at the strength of the stock relative to its past price, we're going to do something a little bit different. This is a twist on the traditional RSI. And we're going to compare the strength of the asset that we're looking at to another benchmark versus comparing it to its past price. And what you'll notice is when this particular way of using relative strength gives us the buy indication, or a green histogram here, the stock is going up. That's what we want to see. Now, this is also when the traditional RSI was telling us it was overbought and not to get in, right? So we want to throw that out the window and use a twist on the traditional RSI. And once the new version of the relative strength method that I'm going to share with you guys today tells us that that stock or whatever asset we're trading is no longer outperforming, as this is the case in this case with Amazon, where over a period of several months the stock was just moving in a sideways channel. This might not be the best time to use a strategy that takes advantage of an uptrend in the stock, or perhaps we don't want to be in the stock at all, or we want to use a bear strategy or a market neutral strategy. So this gives us much more accurate information than the traditional RSI. Now, problem number 2 with the traditional RSI is it only measures the current strength of a stock relative to its past price. So you can see, hopefully, the fallacy in that, because if a stock is is doing well, if it's going up, naturally, by default, it's doing better than it was in the recent past. So you can see how the traditional relative strength indicator can fail us there, because naturally it's going to tell us then that the stock is overbought. But we all know that stocks can go up for significant periods of time and they can go down for significant periods of time. So there's a major flaw in the relative strength indicator that compares its current price to its past price to gauge relative strength. And that's really not the best way to do it. So here's the solution. Wouldn't it make more sense to identify a top performing index or sector and then select a stock that is outperforming it? So rather than compare the strength of the stock to its past price, we're going to compare it to another asset or index or sector that's already doing well. And then we're going to find a stock or asset within that industry or sector that's outperforming it. And that is going to give us that extra 1 degree edge to spot opportunities that are primed to move up in price, and then keep us out of situations if market conditions aren't favorable. And that can really give you an extra edge. And that extra 1 degree difference can even take a losing system and give it the steam that can spot the next stock that is ready to explode. So often when a stock begins to outperform a major index, industry, or sector, it goes on to make a big move up. And the key is to identify stocks that shift from underperforming to outperforming relative to a benchmark index or sector. And then once we identify those, these can really be the golden ticket to beating the market. Because what we're doing is we're taking an index or a sector that is already performing well, and we're spotting the opportunities that are beating or outperforming that index or sector. Okay, so it's kind of a built-in edge that we're giving ourselves. And I can tell you guys that not many people trade this way or look for these types of opportunities, probably because a lot of people don't know how to do this. And I'm going to show you step-by-step exactly how to do this for yourself. But it really can give you an extra edge. And generally when people, join our membership or become a part of our inner circle, they always ask, well, you know, this strategy is fantastic. It's doing very well, but what happens when the market starts to go down? Well, that's the beauty of it. It's the old Jim Cramer saying from Mad Money, there's always a bull market somewhere. The beauty of this system is that even when a market's in a correction or we're in a full-on bear market, relative strength, when used in the way that I'm going to reveal to you today, can help us identify opportunities that outperform the broader markets. So even when the market's going down, we can spot the bull markets within the bear markets and identify these opportunities where even in the worst market conditions, there's always going to be stocks going up, and relative strength can help us spot them. So let's look at a comparison between the relative strength system that we're going to be focusing on today versus the old antiquated RSI method of doing things. So we're going back to the chart of Tesla, same time period, daily chart. And this time we've got the new relative strength formula. And by the way, I'm going to be giving you this formula here in a minute, versus the old RSI. So if we look at October and November and even into December and January, we see that the RSI, as we looked at earlier, is overbought, telling us that this may not be the best time to buy shares of Tesla or whatever strategy we're using to take advantage of a move in the stock. And it gave us misleading information. Okay, but you'll notice here that something interesting happened in around the third week of September. The new relative strength formula tells us that while the stock was kind of moving sideways and flat there in August into early September, something interesting happens here in the third week of September. And this particular formula tells us that Tesla is starting to outperform the broader market, the S&P 500. And we know that at the time, the S&P 500 is already performing very strongly. The market's been going up, right? So we already know that the S&P 500 is doing well. Now, I think the statistic is something like fewer than 1% of professional money managers out there can actually beat the S&P on a consistent basis. Well, this is a way that you can overcome those odds. So if we look at Tesla versus the S&P, which is already performing well, wouldn't it make sense to look at a stock that is outperforming something that's already performing well? Well, in this case, it identified Tesla, which then went up right here, starting in late September, over 1,800% by February of next year. So in a very short period of time, the stock went up over 1,800%, while the old antiquated RSI was telling us it was overbought. Here's another example. This is Teradata, TDC. You'll notice that on the first half of the chart, the stock's not doing a whole lot. It's just sort of rotating between 18 and 22.50 a share for quite a significant period of time. And you'll notice that the new twist on the relative strength formula is telling us this isn't a great time to enter the stock. It's underperforming the broader index until late January. Something interesting happens here. The formula identifies that TDC starts to outperform the S&P 500. Now, again, at the time, the S&P 500 is already going up. So we want to spot opportunities that are outperforming the S&P. And look what happens. The stock goes up 125% in just a couple of weeks. Here's another example. This is actually an example from my hedge fund. I bought this security in my hedge fund a while back because I noticed that Futu Holdings, FUTU, was starting to outperform the broader market. And in early January, as the formula identified this outperformance, you'll notice what happened to Futu Holdings. It starts to go up, and it doesn't just go up, it goes up 380%, from about $40 to $50 a share to over $200 a share in just a couple months. Pretty incredible. So here are the 4 simple steps to identifying these opportunities. And I'm going to walk through each step and show you how to accomplish it. So step one is first to identify a top performing industry or sector. And I'm going to show you a really quick and easy way to do that. Step two is to screen for stocks within that industry or sector. So that takes a little bit more legwork. There's obviously thousands of stocks out there. And this is kind of the more involved step in the four-step system. But once we've found those opportunities, we would then want to compare the relative strength of each stock to an index or ETF that tracks that industry or sector. And that's where the formula is going to come in that I'm going to give you here in just a second. And then we want to select a stock that changes from underperforming to overperforming. So that's more the time critical component of the system, is we want to, if we're going to take a signal, we want to get in right when the security begins to outperform or overperform. So that's the 4 simple steps to trading the new twist on the relative strength. So let's start out with a formula. This is the formula for identifying the performance of one security to another. It may look a little complex, it's really not. I'll kind of walk through it quickly. So we've got a couple data points. So data point 1 is our stock price. So that would be the price of the asset that we're looking at potentially trading or investing in. And then data point 2 is our reference price. So that would be the other asset that we're comparing the asset that we're considering trading to. So for instance, and we'll look at some examples, if we're looking at an industrial stock, because we'll look at a couple industrial stock examples, we would take the price of the industrial stock and compare it to the industrial sector. So we could use like an industrial sector ETF or exchange traded fund. Now, in terms of the logic, if the stock price or the price of the asset we're looking at trading is greater than 0 and the reference price is greater than 0, and they both should be, right? If they're actively traded stocks, then that's going to give us a log value. And the log value is basically the stock price, so the price of the asset divided by the reference price. And in terms of the relative strength component, we have a couple of inputs that we're going to use. So we want an average, which is basically the log value that we just got from dividing the stock price by the reference price, minus the length of the log value, and the RS length that we use is 90 days, and the EMA length. So the EMA is the exponential moving average length, and we use a 3-period EMA length, and then we multiply that by 100, and that gives us the relative strength. So if it's positive, then we know that the asset that we're looking at trading is outperforming the one we're comparing it to. Okay, so that's the formula. Now, here's the secret to finding the top performing sectors. So this is kind of where we start out before we apply that formula. And there's a really easy, simple way to do this. It's on a website that we don't have any affiliation with, but it's one that I use because it's a great free tool. And they do have paid subscriptions and things, but you don't need any paid subscriptions to do what I'm going to show you. You simply go to finviz.com. It's really a fantastic site that is updated on a daily basis, and you can use it for many different things to find different types of patterns and technical and fundamental signals. But we're going to use it for one specific purpose. So if we go to finviz.com and you look at in the upper menu bar, you'll see that there's a tab called Groups. So we want to click on Groups, and that's going to take us to a relative performance page. Okay, and you can select different types of scans under the relative performance, whether you want to scan by industry or by sector or by index. There's different ways to run these. So what we're looking for here, and you'll notice that this is broken down by time period, is we want to look at the 1 week, 1 month, 3 month, and 6 month relative performance. And this is right now comparing the industry or sector to the S&P. Okay, so what we want to look for is a sector that is outperforming on multiple time frames. And specifically what I look for is one of these to appear in the top 3 across each time frame. So if we take a closer look, we'll notice on the 1 week relative performance, industrials is outperforming 3.94%. And by the way, this isn't live current, so don't consider this accurate as of today. This is purely for teaching purposes, demonstration purposes only. If you were to go to the site now, you'll likely see different readings. But when I put together the training materials, this is where we saw industrials in the top 3 across different time frames. So if we look at the 1 month relative performance, we see that again, industrials is in the top 3. It's number 2, outperforming by 4.42%. And then if we look at the 3 month relative performance, we notice it's number 3, outperforming by 11.89%. And finally, in the 6 month, we see it's number 3 once again, outperforming 29.66%. So what we're noticing here is that industrials is a top performing sector across many different time periods, and it's in the top 3. So wouldn't it make sense to scan the industrial sector to give you that extra edge of trading an asset that's already within a sector that's going up? So we don't just stop there, we then take it a step further and apply the formula to look for stocks or assets within that sector that are outperforming or beating the sector that's already outperforming the broader market. So you can see how this kind of builds on itself. So let's take a look at an example of one that we spotted. This is Builder's First Source, BLDR. And you'll notice that in June and July, the stock is going down, right? So going down from about $24 a share to below 20. But then in July, something interesting happens. When we apply the formula of BLDR versus the industrial sector, we see that it starts to outperform. And you can see the incredible timing of this indicator as it spots the stock outperforming before it goes up 113%. Here's another example, John Deere. So John Deere, of course, another industrial stock, one of the top tractor manufacturers in the world. Wasn't doing a whole lot in early July, kind of moving flat, but then started to move up in late July. And on top of that, it was actually outperforming the industrial sector. And look what happens to the stock. It goes up 122% over the coming months. So pretty incredible. Those are a couple of many examples. We could sit here all day and go through these, but that's the first part of the system. Now, here's another critical component, because entering the stock is just one small component of the system. Just like any other system out there, you have to manage the trade, right? So that's probably the most important component in terms of trade mechanics, is managing the position so that it doesn't turn around on us and result in a loss. So let's talk about locking in profits. When we find one of these opportunities and it's starting to work out nicely for us, we have a couple ways to manage the trade. First, we have target number 1, and that is to set a 5 to 10% initial profit target on the first half of the position. So let's say, just for simplicity's sake, you buy 100 shares of a stock. You would want to look at exiting the first 50 shares or half of the position once the stock moves up 5 to 10%. So if you want to be more conservative, you can look at 5%, more aggressive, 10%. And then once that occurs, you can move your stop to break even on the remaining half of the position that you leave open, and then set target number 2, which is a 10% trailing stop on the second half. So on the remaining 50 shares that you would have open, you would set a 10% trailing stop. And that's the purpose of that, is to capture the big gains. So in some of those examples we looked at, you can see that in some of these cases, the stock can move up hundreds or even thousands of percent when you spot one of these really hot stocks, and you want to obviously try to capture as much of that move as possible. And the best way to do that is with a trailing stop. So a 10% trailing stop is the method for target number 2. Now I'm going to go into options a little bit, because I know we probably have a lot of options traders on with us today, and I personally trade options as well. this is an interesting statistic pulled from the CNBC website back on December 4th last year, that options trading, like volume-wise, just took off. I mean, it was already on an upslope over the past decade, but it increased dramatically from 2019 levels. And this is from Piper Sandler, who did an analysis of all the retail broker platforms out there on the market that offer options trading. And they found that the options trading volume last year relative to 2019 was up 50%. So that means there's a lot of new options traders entering the market and trading options. And that can be a good thing and a bad thing, because I remember when I first started trading options back in early 2000, it wasn't as easy as it seemed to be. You know, a lot of people are lured by the leverage and potential large returns, but when it's not done correctly, it can be a very risky market to trade with potentially significant losses when you have a losing trade, which is of course inevitable with any system. So it's a little bit, worrisome to see this large increase or spike in options trading volume, probably largely, as the article points out, due to the pandemic and more people losing jobs and working from home and things like that, trying to find security and other alternate sources of income. But the good news is the relative strength system that I'm sharing with you guys today can be a really great complement to an options trading strategy because of the timing component of it, and it often can spot stocks before they make big moves. So it's really ideal for timing directional option strategies. So whether you guys are buying calls, selling puts, setting up vertical call spreads, bull put credit spreads, calendar spreads, so many more strategies that can really benefit from that timing component of the relative strength system. Because even if you're just simply buying calls on a stock as it outperforms a benchmark index, a 5% move up in that stock, and remember that's our primary profit target number one, that can be 100% options gain. So it's a leverage instrument, but leverage is a double-edged sword. So we want to make sure that we're only using options with a very conservative approach in terms of money management and timing. So let's look at an example of how we could set this up with options. This is Apollo, ticker APO, and you'll notice that in early April, the stock was sort of moving flat there, hovering kind of between $28 and $30 a share, until the relative strength formula picked up the overperformance versus the S&P. And again, sorry about that. The S&P was doing very well at the time. And you'll notice that shortly after, the stock starts to break out of that trend. Okay, so how would we use a call option on this type of signal? Well, on April 16th, when the relative strength formula spotted this opportunity, where Apollo Group was beginning to outperform the S&P 500, which we knew was already in a strong uptrend, that particular day, the stock closed at $29.66 a share. So oftentimes some of these moves, when they do occur, can play out over very short periods of time, even a week or less, and some take a bit longer, maybe 2 or 3 months or more. So typically with options, it makes sense to go out a little bit of time to capture the bigger moves. So in this case, we would go out to the September expiration, and we would select the nearest at the money strike to buy the calls, in this case, the 30 strike. And at that time, those contracts were trading for just $1.70 per contract. All right, so for our example, we'll use 10 contracts. And you'll notice there that if you were to buy 10 contracts of the September 30 strike calls, it would cost you $1.70 per contract, or on 10, being that each contract controls 100 shares, an investment of about $1,700 before any commissions and fees. Okay, so relatively small investment on this opportunity. Let's see how it plays out. Well, in this case, the stock moved up very quickly, as we saw on the chart, and only 6 days later, it was trading up 5%. And that resulted in nearly 100% move in the option. So if we look fast forward to 6 days later, you'll notice that the open profit would be a little over $1,600. So almost 100% return on that $1,700 investment. Now, remember the primary and secondary target components of the system that I mentioned to you. Well, if we're using options, we can apply the same principle. So instead of just exiting the whole trade because we want to give it more time for the stock to go up further, we could close half of the 10 contracts and keep 5 open until expiration on September 20th. So let's look at what happened if we do that. Well, on the first 5, we would have closed out the trade on those when the profit was $1,650. So we would be capturing half of that, or about $825. But if we leave the other half open by expiration, because the stock continued to go up on those 5 contracts, there would have been an open profit of over $4,200. So by scaling out of this, you could have turned a $1,700 investment into over $5,000, or a 297% ROI by using options. Now again, options are a leveraged instrument and are a double-edged sword. So if you're going to trade options, it's really important to have the timing down, and relative strength can help us do that. So now you know that when a stock gains that extra 1 degree and begins to outperform a top performing index or sector, it starts to boil and often results in explosive moves to the upside. And I've revealed my 4-step process for identifying these opportunities. But it does take a lot of time and work to sift through over 5,000 stocks every week to find the very best. And that's what we do for our members, is we do all the legwork for them. So I want to offer that to you guys to do the heavy lifting for you. I've given you everything you need to do this on your own if you prefer to do that. But I want you to, think about the opportunity to receive 5 to 10 opportunities just like this that we send out to our members via email and smartphone every week. So we spot somewhere typically between 5 and 10 of these opportunities every single week and blast those out to our members right as the opportunity comes up. And in fact, you can even take any indicator or system you're currently using and apply it to our top performing relative strength stocks. So we have a lot of members in our relative strength service that simply take our picks and use it, whether it's to trade options or whatever system or strategy they're using. It's very adaptable, so you can adapt these opportunities to any system or strategy. So here's the relative strength package in a nutshell. Everything that comes with your exclusive membership. You get 15 to 20 trade alerts per month, so plenty of opportunities. You certainly don't have to take all of them. And we often get asked, which ones should I take? These are all obviously very rigorously hand selected opportunities. Which ones should I take? Well, one isn't better than another. They're all very stringently selected and tested, and all meet the criteria of the system that I shared with you on our session. So one's not better than another. You can pick whatever one makes more sense for your account, and we offer a range of different opportunities across different prices. So there's plenty of opportunities to go around depending on your account size and etc. And most of them are short to medium term swing trades. So typically, these will play out in a matter of some cases days, as we just looked at on that options example on Apollo, or in some case it might be more like weeks or even a couple months. But there is a potential for large percentage gains in some of these opportunities, as you've seen. And since we launched the service, we've seen some really big gains in some of the stocks that we've sent out to our members. And the beauty is you don't have to do all the legwork. So you'll be alerted the very day a stock begins to outperform a top performing sector or index. So we let you know that that very day, so that if you want to take advantage of it, you can do that by the next trading day. So here's what it looks like and what you receive. You get the ticker symbol for each stock. You get the company name, so you know exactly what you're trading if you're going to take that opportunity. You get the stock price. You get profit target number 1, profit target number 2. And by the way, we also issue these mostly on optionable stocks. So if you want to trade options, we also let you know if there are options available on that particular stock, so that if you're looking at using an option strategy, you can go ahead and do that, as well as our analysis of why the stock is expected to outperform. So you get a lot of really great stuff with this package. So what we're going to do is we're going to throw in 12 months of our relative strength signal service. So that's normally a $1,499 subscription, as well as priority text alerts to your phone. So if you're not at your computer, you're out traveling or on vacation or whatnot, we'll also alert you via mobile at SMS, and that we're going to throw that in as well with the package valued at $299. We also throw in access to our private members only Facebook group with other members who trade our strategies that you can interact with and share successes with, and we're throwing that in valued at $199. I'm also going to throw in our very special course that teaches our whole arsenal of trade adjustments and techniques to fix losing options trades. So if you're an options trader, this is really crucial information to have and is a great complement to the relative strength service. We're going to throw in that whole course valued at $900. We deliver all the alerts after the market closes, so you don't have to day trade. You don't have to be sitting at your computer. You have plenty of time that evening or the next morning before the market opens to determine which opportunities you want to take. And you get 15 to 20 of those per month. And you get to learn alongside us to trade, whether you're trading stocks, options, with consistency. And we do believe, and based on our track record, can prove that we deliver opportunities that are consistent and make money for our members. We're going to throw in a couple bonuses. Bonus number one, our professional trading series online course. This is over 9 hours of our best strategies across different markets, stocks, options, Forex. And this can be watched at your leisure online, valued at $595. We're throwing that in completely free. So you saw one of our really top performing strategies on the session today. We have many more strategies in our toolbox, and you'll get access to all those in our professional training series, as well as our new ebook, How to Create Risk-Free Trades. This is a great money management technique that complements the relative strength signal service. We'll throw that in for you as well for free at $97 value. So the total value on the package is over $3,500, and that is the actual retail cost if you were to purchase these from us all individually. But we are taking a huge percentage off the retail price, 84%, and offering this package up for only $49 a month. So we price this very, very affordably, so that the idea is this should really be, pennies on the dollar for you in terms of what's, the potential is with the service. So at only $49 a month, you get access to everything you see on the screen. It's a steal, and you can take advantage of it by going to altostrading.com/RS49, relative strength 49, RS49. And I believe Anna will be putting that in the chat box for you to make it easier to click. And there it is. And we are just going to open this up for 25 seats. We do, do a lot of coaching and hand-holding. And by the way, you'll be invited to all of our live sessions. We're holding one tonight, in fact, at 7 p.m. Eastern. And so everyone that joins today will be invited. I host those myself. But because we do a lot of coaching and hosting and things like that, we can only take on so many new members at a time. And with hundreds of people in the room, we simply cannot take everybody, unfortunately. So we do limit this to 25 seats. Once those are taken up, we will have to shut the offer down. And it will, if you want, to join anything, you'll have to go to their full retail price at that point. So if you want the 84% off, $49 a month, by the way, you can cancel anytime. There's no contracts. You're not locked into anything. If you try it out for a month and decide, that it's just not fit for your style of trading or whatever, you don't need any excuse. We will go ahead and stop the service for you, no problem. All right, so again, you get access to our best trades right to your inbox. You don't have to sit and watch your computer all day. We do all the heavy lifting for you, and we send out the alerts after market hours via email and priority text message. You get the easy to read instructions, including all the profit target levels. So everything that you need is there for you. And we've designed it for everyone from beginners to seasoned veterans, and we have people of all skill levels, experience levels, who take our relative strength picks and apply them to their own trading. People who work full-time, part-time, we've really designed it to work with any schedule. In fact, we have students in over 130 countries who use our strategies and use them for those reasons because of the flexibility. And whether you're just starting out and you have a small account, you get to decide how many shares to purchase. So it's scalable. You can start out small and scale up as you get more advanced. And as you grow your account, you can start to compound your results. And it's for traders who want to learn how to trade on their own, and for those who also want to be spoon-fed. So we have people on the service that really want to learn to do this for themselves, and that's what I've worked on teaching you guys today. And we continue to build on that education, which is why we throw in so much of the educational stuff into our relative strength package. But it's also for people who want to be spoon-fed and just don't want to spend the time to do the work, and we understand that too. But whichever path you want to go down, we'll help you do that. So what happens next? Well, you're automatically added to our members list and directed to our membership registration page. And then you receive a confirmation email in a few hours confirming your access. We give you exclusive access to the members only portal, and you'll receive your first alert this week. So there's actually going to be an alert going out this evening, so you'll get the very first one tonight. And then we give you the 2 special bonuses that I mentioned as well. And then we also throw in a 90-day guarantee. So if you don't make at least your membership fee back in the first 90 days, we'll give you an extra year of the signals on the house. So that's normally a $1,499 value. We'll throw it in, no cost, because we do believe that you can be successful with this if you apply it yourself. All right, so I pretty much ran up on time. I apologize, but if Anna will give me any questions, I'm happy to answer those. And if not, I understand that we're limited on time, and you can always email us at support@altostrading.com or give us a call at 800-895-9348. And one of our representatives will be happy to discuss the package with you. It is going fast. We've got a few seats left. So if you want to claim one of those, go to altostrading.com/RS49. And back to you, Anna. Thanks everybody for joining and listening.
Thank you so much, Jeff. If you don't mind, can you take 2 questions quick?
Absolutely.
You can pick any, or do you want me to do that?
If you could maybe pick out a couple for me, that would be great. I don't actually have my chat box open here. Or if you prefer, I could try to answer those.
Is there only bullish alerts? What is the win-loss ratio over how many years? Do we get exit text alerts when the market is open intraday?
Great questions. So they are all bullish. So in the case that there aren't any opportunities, which even in bear markets we've never had happen, we would look at doing things like inverse ETFs or funds that go up and inversely track the market when it's going down. So we can make bearish plays on things like inverse ETFs. We provide all of the profit target levels in the initial alert. So there's really you can if it's kind of a set it and forget it type of pick service. So you can go ahead and enter those if you decide to take one of the signals and go ahead and set that up ahead of time in your account. So there's generally no need for us to make any intraday alerts. And I believe that answered the question. I don't know if there was another part of that.
Hello traders, this is Alla Peters, founder of Fibonacci Trading Institute and proprietary Alpha Fibonacci method. In this webinar, I will be teaching you what I have been teaching for the last 10 years, how to trade like a hedge fund trader with Alpha Fibonacci system. But first, I would like to remind you, every single thing you will see in this webinar is for educational purposes only. Nothing constitutes a financial advice. All the content of software system given as is without any warranties. I hope and pray you understand that trading involves risks. No matter if it's futures, stocks, forex, options, ETFs, Bitcoin, anything you choose to trade, and that all testimonials from students are believed to be true, and no one had ever been paid for any testimonials. It's a required disclaimer. In this webinar, we will cover how hedge fund traders think, prepare, and trade with Alpha Fibonacci system, how traders trade futures, stocks, commodities, cryptocurrencies, and Forex with Alpha Fibonacci system, and most importantly, how you can trade like a hedge fund trader with Alpha Fibonacci system. Briefly about myself. I developed proprietary system in 2008. Ever since, I developed over 30 systems. I teach traders from complete beginner to hedge fund manager. I teach children of my students. Currently, I teach 11-year-old Emma of my long-term student Michael, who is trading options with the system, how to trade Alpha Fibonacci system. I also mentored JP Morgan traders, Wall Street traders, financial advisors, and hedge fund managers. Every single one of them trades different instruments, from futures, stocks, Forex, Bitcoin, options, as you will see next. I hold multiple degrees, speak multiple languages, operate multiple businesses. I volunteer globally, and I always travel and meet with my students all over the world. I founded Fibonacci Trading Institute in 2011. So is Fibonacci Trading Podcast and Fibonacci Trading YouTube channel. Here's our community. Here's a couple of the images. And you will meet these traders throughout the webinar. This is the reason I live and breathe what I do. You will see how Richard quadrupled his retirement account, how Manuel brought his wife to the course and what they done during crisis, how Sam put his daughters through Harvard trading proprietary method, how Carol trades oil, and I met with Jason a few weeks ago in California, with Victor in Switzerland. Victor operates hedge fund in Switzerland using the method, and I'm meeting with William again in a couple of weeks. These are only few of our global community students. So ask yourself a question. How does top 1% think? How does top 1% become top 1%? Does top 1% chase cheap systems, cheap indicators? What is the answer? Of course not. Zero interest in delayed indicators that look good only after the fact. Zero interest in chasing cheap random systems. Hedge fund traders focusing on quality. Quality comes in pure price. Here's the system on S&P mini futures right now in front of you. And here's the reason it is traded globally, as I just finished teaching class. In front of you, reversal zone, playing out right now. This was a play yesterday at the time of FOMC. This is S&P E-mini future with Alpha Fibonacci system now. Here's a scanner running in front of me. With Alpha Fibonacci system, you know hours, days, weeks, months, and years in advance where reversal zone is. All of these levels are buy entries, buy points. With the help of a scanner, you can run 20, 30, 50 charts and choose your trade. All of this identified days in advance. This is how you knew days in advance where the key buy points, reversal levels will be. This is how charts looked days in advance. So if you understand the power of reversal entries, you are not spending time babysitting junk. you're extremely well aware what the critical entry points are. And with a system, you can buy at the ultimate bottom. Here is 5-minute chart this morning. Here is 5-minute chart in front of you right now. You are not shorting near. You're only interested in longs. And all of this playing out live. And this is exact same system that applies to any instrument you choose. Pure price is the key, and this remains constant. This is strategic, precise, institutional trend system that removes speculation and allows traders to trade markets as strategic alpha Fibonacci chess across all instruments. So here's a very interesting fact. Here is Bitcoin. If I bring to your attention Bitcoin right now, since the start of 2021, you knew many months in advance where reversal zone will be. You knew many months in advance where Bitcoin will set up for crush. So when Bitcoin staging these pullbacks, there is no surprise. You understand extremely clearly. This is bullish trend exhaustion levels. This is a place you expecting sell-off on Bitcoin from. It's a reversal zone. It's quiet before the crush. So when Bitcoin collapses 50%, you are not surprised. You understand this months in advance. So when my incredible student from a couple of years ago, emergency room doctor Steve, sending me this email, it is very pure and very simple. If you know where to take the profits of the table, if you know where to exit your trade, you sleep so much better at night. You're not losing your mind. You're not losing your money. You are not stressing out. It's identical rules on any instrument you choose to trade. And that's ultimate precision and predictive power. So this is discussions in the trading room with my students from all over the world. As CEO shares, those institutional levels are so potent as Denzel trading Forex, as Sue is killing it on S&P and Amazon and SPY, as Rajesh is trading NASDAQ, as King is trading Forex. Every trader chooses different instrument. Every trader decides what trader wants to trade. So when you come to our website, you can listen to podcasts. This is Sue this week. On our podcast channel, you listen and hear journeys of different traders. Sue is not trading Bitcoin. Steve does. Sue is trading options, S&P, and gold. And that's very different for every single trader, every single day. But what is in common? Pure price for entry, alpha Fibonacci for exits. This is a system in front of you. Pure entry, pure stop, pure targets. Word RZ means reversal. Ultimate precision. You don't need indicators. Indicators developed after price. What you need is rules. What you need is precise entry, precise stop, precise targets, and ultimate institutional point of entry. So if hedge fund traders trade indicator free, why in the world would you chase indicators? Why in the world would you not go straight to the source? Do you want to become top 1%? Stop doing what majority does. Pay attention to pure price, and the skies are the limit if you do. So what's essential and crucial to recognize? These are the markets. This is institutional rally with alpha Fibonacci system in front of you. If I take you back to the markets on S&P mini future all the way to 2019, let me show you how alpha Fibonacci system identified institutional entry point and how markets looked like since December 2019. This is reversal zone December 2019. So when the world is in free fall and everyone in panic, intelligent trader understands what identifies institutional sell-off. An intelligent trader knows many months in advance institutional reversal points. So when price reaches key level 2200, this is what S&P looked like on day trading charts. This is ultimate institutional buys. This is end of March 2020. 10, 15, 20, 30, hundreds of trades on NASDAQ. 30, 40, 50 trades on Dow. Multi-billion-dollar positions are taken. You are very well prepared. You think and trade as hedge fund trader does. We are no longer 2200 level. Market is very different. Intelligent trader understands this well. This is a lesson to every single trader who must know and obey the rules for very different markets, institutional entries versus institutional holds. This is quiet before the storm. Many months in advance, you must prepare for 4500 level. Intelligent trader knows this well. And if you are, the sky's the limit. You are not panicking. You are not losing sleep. You understand many months in advance that institutional reversal levels are crucial, critical. And when you do, you're not losing money, no matter what crisis is in this world. Because when you're looking at this chart, do you see the crisis or do you see the joy? Top 1% just became 50% richer. There is no crisis at this chart. And if you knew months in advance where institutions trade, and if you understand your trading range every single day, and if you think as hedge fund trader does, the sky's the limit. As I just taught in the live class. So this applies to any instrument. This applies to any account, indicator-free system with multi-market scanner and proprietary alpha Fibonacci software. This is for Ninja 8, and you can also trade lifetime system on any platform. System consists of only two components, indicator-free price and proprietary alpha Fibonacci retracements. You will never need anything else, ever. So I love stories of our students. Richard signed up for the course right after he heard the webinar. And when he signed up, he started thinking and trading as hedge fund trader does. Listen to Richard's podcast. First, he doubled his demo account with Market Replay on Ninja, and then he started trading live with only $3,600 on December 7th, 2020. Months and a half later, his account 11,500. February, his account 18,400. April, his account 37,000. And this is critical point. If market stuck, I do not trade that day. The sky's the limit. If you think and trade as Richard does. Listen to Richard's podcast, as now he's making 4 times as what he was making in a week while working as a therapist. If Richard can do this, so can you. With Alpha Fibonacci trading system, trader can trade any instrument 1, 5, 15 minute, hourly, daily, weekly, monthly. So let's review a couple of examples, shall we? Here's Apple. 2020. I'm sorry, this is 2015. Apple comes out with the worst earnings. I present at the world's biggest hedge fund convention. And what do I say? That if this support is respected, Apple will skyrocket. Despite worst earnings, Apple doubles in value. Many months in advance, you know where next level will be and where Apple would crash and burn from, no matter how great the earnings are. So when Apple reaches next level, you start protecting your profits. You are preparing for Apple crash. When Apple's selling off, there is no surprise. When buyers step in from the bottom, 140 level. This is the power of the system. And this is what you can trade on any instrument you choose. It's identical thing on Apple. It's identical thing in front of you on S&P right now. On Apple, it's 140 level. On S&P, it's 4,200. It's 4,214. That's it. If you can trade one instrument, you can trade them all with Alpha Fibonacci system. System is drastically more accurate than earnings or news will ever be. So when Andy joins the course and shares that his son started trading the method, who is Andy? He's a hedge fund manager in London. Andy tripled his account long term, and as you will see next, his son Dominic, 14-year-old, trading the system. Ken trading Bitcoin. Scott trading stocks. Every trader different account, but what do you see? Do traders work much? No. Andy, 8 hours maximum per week, down 2 hours maximum in the morning. Brad, maximum 20 hours per week. As Don says, beautiful setup, done, going golfing. Focus on the quality of your life. Do what hedge fund traders do. Think as hedge fund traders think. Pure price is what matters. No indicators needed. So if you would like to day trade gold, of course you can. This is a system in front of you. Precise entry, stop, and targets. So when Gerald joins the course, 37-year actually veteran of CME floor trader, what does it show you? 14-year-old trading system, hedge fund trader trading system, experienced trader trading system. But then there is no surprise. He's trading 800 lots. Jennifer not. Jennifer trading very, very few. And that's very different journey and story. And the reason I love what I do. It never gets old, I promise. You decide what you want to trade. But if you think as hedge fund trader does, the skies are the limit. You can trade Amazon. You don't have to trade S&P, Bitcoin, or Apple. And if you know many months in advance, well before earnings, where Amazon would crash from, more than $700 per share, you're extremely well prepared. Amazon continued selling off from reversal zone that you knew many, many months in advance. And that's what Scott trades on stocks. Institutional trader with spectacular effort. Every trader different background, every trader different account. So when you prepare and strategize with institutional power, you stop stressing out. You start trading as institutional trader, no matter how small or large your account is. And that's what Theo shares. Trading with those powerful institutional levels is going with the market flow of the smart money. There is no other way to trade. This is the only way. And that's how traders perform at institutional levels, from stocks, forex, options, on any instrument. And that's our global community of traders trading this, trading pure. This is Dow E-mini futures. Precise entry, stop, and targets. You buying ultimate bottom and Dow collapsing from reversal zone. And that's what matters in the market. Institutional levels, precise entry, precise stop, precise targets. So if Dominic can do this during crisis and enjoy trading so much, so can you. You will know many months in advance where ultimate bottom is. Here is oil. You're looking at ultimate bottom on oil 2016. So when oil picking up this steam, the only obstacle that left, the end of the minor trend. And when oil more than doubles in value 2 years later, you know many, many months and years in advance where oil would crash from. So when oil's selling off, as an investor, you exiting your longs on oil stocks. You are not panicking, you are not losing sleep. As an options trader, you're using various derivatives to short with different option strategies. As day trader, you're shorting institutional top. And you also know many years in advance that oil heading extremely low. Skip to 2020. What do you see at the bottom? Ultimate bottom, ultimate reversal zone. You're buying stocks at the ultimate low. You understand the power of this. As a day trader, you're buying with institutions. As investor, you're investing in multiple oil stocks. You are not stressing out, and you are not shorting near these levels. Never, ever, ever. You are obeying the rules, and at reversal zone, your only option to buy from. So when Mustafa is sending me this email, our student in Saudi Arabia, he started with 100,000 account in 2019. Now he has about 250,000. Mustafa is my friend for life. You can listen to his podcast on our website. So, what would your trading be like if you know institutional entry points in advance? And that's the power of the system. And that's ultimate way to trade. If you know your trading range prior to your trade, understanding that every single day your trading range will vary and every single day market conditions will change, what you see on this chart, what plays out in front of you in the live markets on S&P is a very powerful example. Every single day we were at a different trading range, but this remained constant for many, many days. At reversal zone, your only option to buy from. That's it. So never, ever, ever short near reversal zone. Obey the rules and the skies are the limit. You stop stressing out, you stop speculating, you start trading with quality. And that remains constant, and that will never change. This is a critical, crucial part. You are not buying near this level. Do you remember this level on Apple? Apple obeyed this level for months. At reversal zone, your only option to buy from when price at ultimate bottom. Here's Joseph, hedge fund manager. How about your oil trade? I feel greedy. Look at that pink line bounce. Here is the current chart on oil, 2021. This is the critical, crucial reminder, the pink line bounce. And do you remember oil yesterday came out with spectacular bullish news? We have more than 3 times undersupply on oil, but intelligent trader would never buy oil here. This is what oil has done since bullish news. Oil collapsed. How many points? This was the bullish news. This is your day trading chart. You are not buying reversal zone as ultimate institutional exit point. That's the power of the system. Buy the ultimate bottom, not the ultimate top. And that's the reason for oil crash, despite bullish news. Oil sold off more than 300 points. And that's the reason I work with traders all over the world. And since we started the webinar, how many points did S&P skyrocket already? We started the webinar at 10:15, correct? This is what we discussed. The only option to buy from, S&P already up 8 points. Intelligent trader understands and very, very well prepared days in advance. Everyday market is different. Everyday trading range will vary. This will be war zone on S&P. You know this many hours in advance. But this is a stepping stone system. This is where S&P crashed from the previous 3 hours. Stepping stone. One step at a time. No speculation here. It is all precise. So what would your trading be like if you knew where day trading and institutional levels are? Would you produce drastically higher quality in your trading? Even if you decide to trade Forex? Do you remember the powerful bold pink line? This is a crucial institutional support that pound respects for many, many years. So how is it possible that when UK incomplete lockdown, that pound skyrockets? Is it possible because you knew many, many months in advance that it's a reversal zone at 1100 level? No surprise here, none are present. And that's very powerful lesson. Pound skyrocketed from 1100 despite UK being on complete lockdown. But if I take you to Euro right now, here's Euro. Euro selling off. You know, many, many hours and days and weeks and months in advance that this would be key level on Euro. 115 is a lifeline on Euro, the bold pink line. It's a stepping stone. One step at a time. You are not buying Euro at reversal zone. You know many months in advance that Euro would crash from this level. So if I take you back with a system to December 2020, this is what chart looked like. December 1st, 2020, more than 6 months ago. This is the power of the system. You are no longer gambling. You are no longer speculating. You're thinking and trading as top 1% does. With quality, exiting your longs at reversal zone. Euro, December 2020. You knew many, many months since spring 2020 that Euro would crash from this level. And that's the reason I love what I do. Many, many more strategies later. Our global community all over the world showing every single day. The skies are the limit if you obey the rules of the Alpha Fibonacci system. So if you decide to join us, it's one of the smartest things you have ever done. Please come to the website and let me walk you through. Number 1, sign up for the trading room invitation. In the trading room, you can see the power of the system live as you just saw it on S&P Mini Future. And if you read the review in detail, that system traded globally for the last 10 years. And if you listen to our traders, how Brad went from $10 an hour to $3,500 per day, supporting family of 5, how Manuel brought his wife to the corals, how Carlton trades for a hedge fund, Ken made movie about his life, trading cryptocurrency, you saw Richard's story, David trading it all. But if you like to see more, read students' emails. I keep updating what I receive every single day. So when Theo right now in the course shares that he loves to trade Forex when futures do not move? Of course you can. This is what Theo shared in the trading room. Party boards loves to trade Nasdaq. And that's every trader's different account. Brett is a legend, as he says, every single time he calls. When he decides to trade at the right place, of course you can. And that's our global community, from beginner to hedge fund manager. If they can do it, so can you. You simply have to make an effort and obey the rules on any instrument you choose. So please review the options appropriate for you. Currently, we're offering the biggest discounts ever. This is a lifetime system for any platform, a lifetime software for Ninja 8 with group course or private mentoring, video library, live classes, modules included. In private mentoring, I hold your hand, I test you, I quiz you, as well as I concentrate on your individual mindset, as it is a crucial part of your success. So please review all the information on the website and do not hesitate to contact me. If you click on the upper left corner, 925-257-4298 or info@fibinstitute.com. You can call, you can email with any questions you may have. I highly encourage you to listen and review what traders do globally, because if they can do it, so can you. Any questions for me? Please do ask. We also have massive number of videos, thousands and thousands of videos on our YouTube channel. So if you cannot come to the trading room, please view videos on YouTube channel. All the videos from our live trading room. So thank you, traders, so much. It's been my joy and pleasure being with you. If you're serious about being successful, I look forward working with you. If these traders can do it, so can you. The skies are the limit if you obey the rules of the Alpha Fibonacci system. You can trade any instrument you choose.